Governor Varga, Excellencies, distinguished speakers, ladies and gentlemen. I warmly welcome all of you to the Lámfalussy Lectures Conference organized for the 11th time by the Hungarian National Bank, the Magyar Nemzeti Bank, the Central Bank of Hungary. My name is Bence Mohai and I'm honored to serve as a host for today's event. The Lámfalussy Conference is one of the key fora for European and global thinking on the economic policy that provides a platform for central bank governors and respected financial professionals to discuss the most urgent and topical issues related to global economic policy, particularly those related to monetary policy and financial stability. The theme of this year's event is Global Imbalances in a Changing World Order, reflecting on the most pressing challenges of the global economy. Discussions will cover the dominant role of the United States and the dollar in the international financial system, as well as the growing economic differences between countries. Recent crises, including the pandemic, geopolitical conflicts, and the energy crisis, have further increased these imbalances. The panelists will also examine how geopolitical changes and the efforts of the United States to reduce trade deficits could reshape the global economy and financial system in the coming years. Our program begins with a high-level opening session featuring prominent speakers, followed by two panel discussions. First and foremost, it is my pleasure to invite Mr. Mihály Varga, Governor of the Magyar Nemzeti Bank, to deliver his opening remarks.
Thank you. Good morning, everyone. Dear Madam Governor, dear governors, dear guests, ladies and gentlemen. I welcome you to the 2026 Lámfalussy Lectures Conference of the National Bank of Hungary, held this year for the 11th time. This conference was first organized by the National Bank of Hungary 13 years ago. However, this year's event also marks the beginning of a new era, as the National Bank of Hungary has had new leadership since March last year. This year, I have the privilege of addressing you for the first time as host of the Lámfalussy Conference. Welcome to Budapest. So, ladies and gentlemen, Professor Alexandr Lámfalussy, the namesake of our conference, was widely known for his view that stability and growth would increasingly depend on cooperation among nations' future. Today, we can clearly see how right he was. Over the next few minutes, I would like to share a few thoughts on the conference ahead, focusing primarily on the importance of cooperation. In light of recent years, we can say that the period in which global economic and financial developments were characterized primarily by predictability is gradually fading into the past. It is becoming increasingly accepted in the financial world that crises, new challenges and risks and unexpected transformations have become permanent features of the global economy. Uncertainty has become embedded in the external environment and framework conditions, and although we all hope that this period will eventually be behind us, no one can yet see when that will happen. Ladies and gentlemen, the new leadership of the National Bank of Hungary began its work last March in this new global economic environment. In periods such as these, in line with Professor Alexandr Lámfalussy's insight, focused on cohesive cooperation becomes more important than ever before. In light of this, the new leadership of the National Bank of Hungary has laid new foundations for the bank's operations. The essence of the new operating model is streamlined to the central bank and focus its resources on its statutory core mandate, namely achieving and maintaining price stability. Without jeopardizing this objective, the central bank supports the economic policy of the governments of the day in line with the principle of mutual respect for institutional competencies. In addition, the central bank uses the instruments at its disposal to strengthen the financial stability of the Hungarian economy and cooperates with the relevant economic stakeholders. Given that central banks operate by their very nature in the international context, cooperation within this international sphere is also of great importance. For this reason, the new leadership considered it justified to place the coordination of work related to the international challenges affecting monetary policy under a dedicated deputy governorship at the National Bank of Hungary. I am pleased to say that this year's Lámfalussy Conference was organized with the contribution of this new deputy governorship for international affairs. As I mentioned earlier, the very nature of the central bank's responsibilities justifies international cooperation even in times of peace. However, as noted earlier, in the recent years we have left behind these times of peace for an uncertain period. We are witnessing an unprecedented realignment of the centers of gravity of the global economy. Alongside the rise of China, the dominance of the United States is increasingly being challenged, while Europe's relatively decline is becoming more and more apparent. Or we may think of the new technological solutions emerging in the background and their often hand-to-follow pace of development. New solutions based on artificial intelligence may bring about further economic and social transformations beyond the trends already visible today, including developments that are not yet foreseeable. As a result of these often conflicting developments, global imbalances in the world economy have risen to record levels in the recent years. This is reflected in the title of the today's conference and is also closely related to the panel discussions on today's program. As an introduction to the presentations, let me simply note that these imbalances and underlying developments represent a global challenge. For this reason, we can be truly effective only through joint efforts to identify solutions that may contribute to strengthening the security and the stability of financial systems in the global economy. Ladies and gentlemen, for us here in Europe, the need for international cooperation is made even more urgent by the fact that the crisis currently unfolding in the global economy pose particularly significant challenges for our continent. Alexandre Lámfalussy is remembered by his contemporaries as someone whose thinking, shaped by the experience of the World War, was guided by the future of Europe and by the goal of achieving European unity and peace. This may therefore also have been the main motivation behind the creation of the euro, aimed at fostering the financial integration of the continent. Allow me to say a few words about Hungary in this regard as well. By joining the European Union, Hungary made a prior commitment to adopt the euro. My position on euro adoption has remained consistent over the past decade. It is in the interest of the Hungarian economy to meet the conditions necessary for adopting the euro, while the introduction of the euro cannot be an end in itself. The timing of the euro adoption, and prior to that, the accession to the ERM2 mechanism, is appropriate when the Hungarian economy is able to maximize the benefits while minimizing the risk associated with a fixed exchange rate regime and the single currency. The decision on accession will, of course, be taken by the government. For our part, the National Bank of Hungary is and will remain a constructive partner to the government in meeting the Maastricht criteria. In this respect as well, the central bank has a key role to play in preserving stability and in achieving and maintaining price stability. Let us begin with price stability. Over the past year, domestic inflation has been brought back within the central bank's tolerance band. Our objective remains to anchor inflation, ensuring the rate of price increases remains durable within this range. Another area of monetary policy is strengthening stability and resilience. Today, the Hungarian economy has record high international reserves, including foreign exchange reserves of around 60 billion euros and gold reserves amounting 110 tons. Thanks in part to the monetary policy pursued over the past year, the exchange rate of the Hungarian currency, the forint, against the euro has strengthened from the previously prevailing level of around 410 to below 360 on a sustained basis. Such a degree of appreciation has not been seen since the change of regime. As can be seen, we have launched a number of initiatives across several areas, which, particularly in the light of the results achieved so far, we intend to continue pursuing in the future. Ladies and gentlemen, in conclusion, the ultimate value of today's conference will depend on whether it enables us to strengthen our collective capacity and cooperation in addressing the imbalances referred to the title and reinforcing stability. If we are able to broaden the range of views that we can regard as common ground, then the 2026 Lámfalussy Conference will already have fulfilled its purpose. Given the distinguished list of speakers and guests present today, I believe we have every reason to be optimistic in this regard. I wish you fruitful discussions, valuable knowledge sharing, and successful networking. I would also like to once again congratulate Adam Glapiński, who yesterday received the National Bank of Hungary's distinction, the Alexander Lámfalussy Award. Thank you for your kind attention.
Thank you very much, Governor Varga, for setting the tone, setting the stage for today's discussion. In 2026, as Governor Varga has already mentioned, Mr. Adam Glapiński, Governor of the Narodowy Bank Polski, is the recipient of the Lámfalussy Award. The Magyar Nemzeti Bank is honoring Governor Glapiński for his lifetime achievements and his ongoing efforts to safeguard price stability while supporting the economic transformation in Poland. It is my pleasure to invite Governor Glapiński to deliver the Lámfalussy lecture.
Ladies and gentlemen, dear colleagues, let me start by thanking once again Magyar Nemzeti Bank for this prestigious recognition. I feel honored and privileged given the outstanding achievement of Alexander Lámfalussy and his contribution to the banking community and the European economy. In my speech today, I would like to share my reflections on the topic of today's conference, which is global imbalances in a changing world order. I will try to draw conclusions stemming from the changing global geopolitical landscape for the European economy and central banking. There are three key developments in the global economic and geopolitical landscape that I consider highly relevant from the European perspective. First, geopolitical tensions are rising globally. Like it or not, wars and conflicts have always shaped and will shape human history. This is human nature. However, according to a recent IMF publication, the number of active wars worldwide has surged to more than 60 at present, which is the highest level since the end of World War II, over 60. These tensions are not isolated. They resonate globally, from Eastern Europe and the Middle East to the Taiwan Strait. For smaller states, these tensions create acute vulnerability. In Poland, we understand the grim logic of Thucydides, the ancient Greek historian, who famously wrote that the strong do what they can, and the weak suffer what they must. And this is our situation. We have repeatedly experienced those harsh realities of international relations. With our history in mind and the aggressive stance of Russia towards its neighbors, Poland is a front-runner among NATO countries in terms of military spending as a share of GDP. Although higher military spending puts pressure on public finances, we want to ensure that history does not repeat itself. Second development in the global landscape is the change in the relative power of nations. After the fall of the Soviet Union, global power became unipolar, with the United States, Poland's key ally and security guarantor, emerging as a dominant global hegemon. However, the end of the Cold War did not mark the end of history, as some might have naively assumed in the early 1990s. Since then, the rise of China has reshaped the global order. China's share of the global economy has surged from 4% to 20% in the recent 35 years, from 4 to 20. This process has been accompanied by an expansion of Chinese technological and military power, thereby broadening China's influence on the global geopolitical scene. This brings us to the so-called Thucydides trap, a concept coined by American political scientist Graham Allison. It draws a parallel to the ancient conflict between Sparta and Athens, suggesting then when a rising power confronts a ruling one, a rivalry becomes nearly inevitable. It is therefore very likely that the competition between China and the US will remain a defining feature of the global geopolitical landscape in the years to come. At the same time, the rise of China has immediate economic consequences. While the surge in Chinese exports offers for central banks a disinflationary silver lining, this is a case in Poland also, it is weighing heavily on industrial activity worldwide. This creates a first-order challenge for European manufacturers. This observation leads me to the third development shaping the New World Order, the decline of Europe's relative power. In 1990, not so long time ago, the countries that now make up the European Union accounted for around a quarter of global GDP, 25%, just like that, measured in purchasing power parity. Today, that share has fallen below 14%, from 25 to 14. This process has been accompanied by declining competitiveness, a decline in hours worked over average European employee, and an increase in bureaucracy and over-centralization, both at national and EU level. Most recently, competition from China has challenged industries that were long seen as the crown jewels of Europe manufacturing, such as automotive industry, for instance. At the same time, the continent has demilitarized. It continues to rely on the US security umbrella and nuclear umbrella, while American economic and geopolitical interests are increasingly shifting towards the Pacific, what is natural and obvious. Today, the European leaders in Brussels, yet very late, have finally acknowledged that Europe must immediately wake up and adapt to a changing global order. Now we must make sure that these declarations are followed by decisive actions to boost Europe's economy and strengthen its global standing. Europe still holds great potential. It is a free trade area of 450 million people, forming one of the largest markets in the world. It also benefits from excellent universities, high human capital, and strong social cohesion. So how can we unlock this potential, this European potential? Let me explain with an anecdote. There is a famous quote attributed to Jean-Baptiste Colbert, the French Minister of Finance under King Louis XIV. The story goes that Colbert asked a group of merchants how the government could help them. Their response was, laissez-nous faire. Simply, let us do it. What is the message of this story? I believe that we need to acknowledge that regulation at the EU level has gone far, far too far. The Draghi report highlights that between 2019 and 2024, the EU passed 13,000 acts on top of the national legislation passed by each member state. 13,000 acts. This striving for uniformity and regulation at the EU level forces member states into a one-size-fits-all jacket that ignores local realities. Consequently, it is very often hampering growth and competitiveness of individual member states. Let me provide an example. While the European Union leads the world in climate policies ambition, it accounts for just 6% of global emissions. The resulting high energy prices place European industry at a competitive disadvantage vis-à-vis the US and China, where energy costs are a fraction of those in Europe. What is more, these are very often Chinese companies rather than European ones that are benefiting from Europe's green transition, so-called green transition. A prime example is the swift expansion of Chinese manufacturers into the electric vehicle market. At the same time, the EU climate policies have a disproportional impact on coal-dependent economies such as Poland. In effect, carbon pricing accounts for more than 40% of wholesale electricity prices in my country, in Poland. It is a direct threat to our competitiveness, which so far, given the hard work and the Polish spirit of entrepreneurship, stays high. It also impinges on Polish sentiment towards the EU. European integration could be perceived by some as a burden rather than a benefit. Therefore, if we want to enhance the European project and boost Europe's growth, we must pivot from uniformity to flexibility. Europe needs less regulation, less bureaucracy, and more space for each member state to breathe, compete, and shape policies suited to its own economic realities. Let me now move to the second part of my speech, where I will address the implication of the shifting global world order for central banks. In my view, there are four main conclusions in this regard. First, amidst geopolitical turbulence, central banks must remain anchors of stability. Their primary focus should stay on keeping inflation low and maintaining confidence in the monetary system. This view will also prominently features in Alexander Lámfalussy's work, who cautioned against diluting objectives of central bank. It is encouraging that central banks in recent years have demonstrated the ability to deliver on their mandates. Following the mega shocks of the past years, inflation in many economies has returned to the targets. In Poland, inflation has remained within the NBP target since July last year. It's about 3%. Nevertheless, we are facing another negative supply-side shock driven by rising oil prices due to the new war in the Middle East. The magnitude of this shock is much, much smaller than of the shock triggered by the Russian invasion of Ukraine. At the same time, general macroeconomic conditions are not comparable to those that we had to face 4 years ago. In particular, today demand growth in the global economy is moderate, while 4 years ago it was booming amid post-pandemic rebound in consumption. At the same time, the Polish economy has a very good starting position to withstand the consequences of the current energy shock. First, inflation currently stays within the target. Second, there are no macroeconomic imbalances. Output gap is estimated to be close to zero, and GDP growth remains balanced, around 3.5% at the beginning of 2026. Third, wage growth in the enterprise sector has recently moderated to its long-term average, slightly above 6%. Fourth, longer-term inflation expectations remain well anchored, while the current Central Bank of Poland policy rate is at 3.75, making the policy stance much more restrictive than after the COVID pandemic. We still provide very restrictive monetary policy in Poland. Therefore, we take our time to assess the implication of the current energy shock on the medium-term inflation prospects. While we stand ready to act, if necessary, of course, we remain data-dependent and do not pre-commit to any specific course of action. My second sharp conclusion is that central banks need to stay independent. This is another fundamental principle of central banking that Alexander Lámfalussy strongly advocated. Only with independent central banks will the long-term price stability be maintained, which in turn will make our economies less vulnerable to potential turbulences stemming from the changing world order. Unfortunately, today the independence of central banks worldwide is often challenged by political reasons, from America to Europe. Even when attacks on central bank independence are merely a part of political rhetoric, they are extremely harmful. They may lead to reduced public confidence in the independence of the central bank. This in turn can result in a higher inflation expectations and higher inflation. Ultimately, this may lead to persistently higher interest rates, undermining the state's credibility and increasing the cost of servicing public debt. Independence of the central bank is therefore not a privilege granted. It is a prerequisite for the effective fulfillment of their mandate. My third conclusion relates to the role of having a national currency and not prematurely joining the euro area. Certainly, Alexander Lámfalussy, as one of the founding fathers of the euro, was an advocate for monetary union. However, he was also pragmatic and knew that there are risks related to premature monetary integration. In particular, he often stressed that ensuring sustainable convergence was a critical condition before adopting the euro to secure net benefits of monetary integration. I share strongly that conclusion, As regards Poland, our economy is still converging, with GDP growth very often 3 times faster than in the euro area. We have very often 3 times faster economic growth than in the euro area. Faster growth also means that our economy needs higher interest rates. It is obvious. Faster growth also means that our economy needs higher interest rates than in Eurozone to maintain balanced economic growth. Over the long term, our policy rate was on average more than 2% higher than in the euro area. 2% higher than in the euro area, in the long term. We could observe the situation in the Baltic states. Premature euro adoption in Poland would therefore lead to a fall in interest rates below the equilibrium level, to the level of Eurozone. The result could be a classic boom-bust cycle, an initial acceleration in GDP growth driven by credit expansion, followed by a deep recession, rise in unemployment, and protracted loss of competitiveness. This pattern was observed in already several countries following the euro adoption, Baltic states and others. And the economic growth is much more lower than before. At the same time, floating exchange rate of the Polish zloty acts as a buffer against shocks. It stabilizes business cycle and protects labor market from large and costly swings in unemployment. This mechanism helped Poland to keep unemployment very low despite mega shocks all the previous years. Overall, by joining the euro area too early, we could destabilize our economy and make it more vulnerable to shocks. Therefore, a discussion on the economic advantage of adopting the euro in Poland will only make sense in the future, as Polish economy achieves GDP levels similar or higher to those in advanced euro area economies. It means in the distance of 8 to 10 years. Let me now move to my last conclusion for central banks. The changes in the global order may also resonate within the global financial system. Having this in mind, the National Bank of Poland decided to diversify part of its reserves away from fiat currencies towards gold, a safe haven asset that does not rely on a promise of repayment. As John Pierpont Morgan famously said in 1912, money is gold and nothing else. Everything else is just a credit. We plan to increase the stock of gold in our assets to 700 tons. This move would place Poland among the world's 10 largest central bank gold holders, which I believe is only reasonable given the relentless rise in economic strength and importance of our country over the past 2 decades. Doesn't mention the danger of war. The yellow metal is not a bet against any currency. It is simply an additional layer of insurance. Coming after a period marked by mega shocks, our purchases communicate to both investors and the Polish people that we can withstand shocks, meet external obligations, and maintain financial stability, come rain or shine in the future. That message strengthens confidence and trust in the Polish zloty and the Polish state amid the changing world order. And 16 years in monetary policy making has taught me that there can hardly be anything more important for central banks than trust. Thank you for your attention.
Thank you very much, Governor Glapiński, for this engaging speech. It is now my honor to invite Mr. Martin Kocher, governor of the Österreichische Nationalbank, the central bank of Austria, to deliver his keynote speech. Governor Kocher, the floor is yours.
Dear Governor Varga, dear Mihály, dear colleagues, distinguished speakers, distinguished guests of today, dear ladies and gentlemen. It's a great honor to be here today in Budapest and addressing you. It's always good to be here. Thanks for the very kind invitation and congratulations to Governor Glapiński for receiving the award yesterday. I would like to congratulate you on choosing such a timely topic, global imbalances in a changing world order. Allow me, for the sake of the argument, to view the current world through the lens of a medium-sized, innovative, export-oriented company in Europe, one of those of which we have so many successful ones in Hungary, in Austria, and in other European countries. Let us take a very specialized auto part producer with a couple of hundred workers in Hungary, for instance. For this fictitious company, call it Only Up for ease of reference. The last decades have always been challenging, and adaptation to change was the secret of success for the company. Only Up, our fictitious company, has expanded over the decades. It has developed new patents. It has explored new markets in the world. It has had better, but also worse years. But it was one of these medium-sized industrial companies that guaranteed stability, especially also in rural areas where they are located. Overall, both the management and employees knew that they could wrestle well with exogenous shocks, and the overall expectation and trajectory was positive, at least until 2020. Since several years, the people at Only Up have the impression that our world is changing at a speed that feels somewhat unprecedented, at least to our generation and to us in Europe. Demographic change leads to higher costs and deteriorating public finances in some countries. Technology changes quickly, and most of the new corporate giants that develop and market these technologies are based outside of Europe. A new wave of protectionism makes it harder for Only Up to sustain its international presence. A new wave of interventionism creates additional costs for Only Up, adding to a cost disadvantage in production due to high energy prices and quickly growing wages. And very recently, new imbalances have arisen. Rules, international norms, and agreements appear to have been replaced in some places by transactional considerations announced on social media channels, creating political imbalances, uncertainty on top of structural economic ones. Obviously, it is our task to address these imbalances, these fears of people at Only Up and of many others in our countries, in a calm, analytical, and self-confident manner with the necessary economic foresight. We all know that Alexandre Lámfalussy was a convinced European who believed that Europe must be built through cooperation, shared responsibility, and collective decision-making, not through unilateralism or not through pure power games, because those do not align well with our modern European tradition after very bad experiences over centuries with such games. And they do not align well either with our shared democratic values and the rule of law. Therefore, I see it as European competitive and comparative advantages to continue to build on common rules and agreements, a stable and predictable rule-based order. And in this context, let me focus on a strong European institution now, based on clear rules and on considerable foresight several decades ago that has been developed further over the past decades. An institution which is one of the cornerstones of European integration. I'm talking about Economic and Monetary Union, EMU for short. EMU has clearly shown positive effects of commonly agreed rules and sound agreements. It has added to stability in parts of Europe. It has helped the Only Ups, especially those, of course, in the euro area, to reduce costs of international transactions within Europe. It has added to the attractiveness of the EU with its single market. And it has provided Europe with a level playing field with other large currency areas such as in the US, China, or Japan. Given that this conference is dedicated to one of the fathers of the euro, my speech will focus on why and how the euro can play this important stabilizing role, both globally and for Europe. Of course, I will also point to areas where we need to improve and strengthen the euro. Last but not least, I would like to share my thoughts on prospects of euro adoption in those countries that have not yet introduced the euro within the European Union. Within a short period of time, it's about 25 years since introduction, the euro has been established as a common currency of the world's largest consumer market, the single market. It has also become the second most important international currency. 1/5 of global foreign exchange reserves are held in euro nowadays. As such, the euro is coming second, of course, to the US dollar with a share of slightly less than 60%. The attractiveness of the euro has further increased recently as evidenced by international debt issuance and foreign investor demand for euro area assets. When we look at trading invoicing, the US dollar remains number one globally, of course, yet within the European Union, about 2/3 of trade is invoiced in euro. This shows that people have a lot of trust in the euro, both abroad and at home. The independence of the ECB, a major source of that trust, is an international example, and the euro area has geographically been growing steadily over the last decades. Let me emphasize that trust in the euro is high also in EU member states that have not yet introduced the euro. We can see that from our annual Österreichische Nationalbank Euro survey. We do that every year in more than 10 countries. In most EU countries of Central, Eastern, and Southern Eastern Europe that have still their own currencies other than the euro, people generally trust the euro more than their local currencies. When we look at Hungary, according to the survey in late 2025, less than 40% of respondents reported that they expect the forint to be stable over the next 5 years, while more than 70% expect the euro to be stable. Should the euro take an even stronger role internationally, given what we've been seeing? An alternative that would serve perhaps not only European interests, but also the rest of the world well. First, the expansionary fiscal policy of recent US administrations and the debt ceiling rules, which have been leading to frequent fiscal cliffs, raise questions about the long-term sustainability of US government debt. But long-term sustainability is a necessary condition for a safe asset. For the euro, we have an important mechanism in place to ensure this sustainability, the Stability and Growth Pact. The Stability and Growth Pact is not perfect, but at least rules are in order, and EU countries so far have largely been following those rules, both out of self-interest, of course, to create fiscal space, but also to avoid excessive deficits or reduce them according to the rule book in the Stability and Growth Pact. But although Europe has established rules for long-term fiscal sustainability, it does not provide a common safe asset. Second, some voices have raised concerns recently that the US administration is using the international position of the US dollar for its geopolitical interests. Indeed, the US have been able to effectively impose, of course, financial sanctions in the past based on the strength of the dollar. And it has increasingly used this instrument in the past decade. This becomes problematic if such sanctions are imposed to support purely national interests rather than punishing violations of the international rule-based order. Third, what if the US is no longer willing to take on the exorbitant duty of ensuring the rest of the world in times of crisis? This exorbitant duty is the flip side of the exorbitant privilege of being able to finance external deficits cheaply abroad in normal times. It refers to net wealth transfers when risk is on. In such crisis times, foreigners tend to buy US assets, the US dollar appreciates, and related valuation effects cause a stabilizing net wealth transfer from the US to the rest of the world. We might have to start thinking what role the euro could play in such a situation and whether we would be willing to accept such a role at all. But let me come back to Europe now. There's obvious and not so obvious benefits of euro area membership. The only ups, our fictitious companies in the euro area clearly have benefited from the euro, but so have many travelers and also tourists in the euro area, in particular in countries that still have a high cash ratio in transactions such as Austria, but also, of course, customers paying by card as card networks charge significant foreign exchange fees. Above all, and obviously the changeover to the euro leads to lower transaction costs and it substantially reduces foreign exchange rate risk. What is more, a switch to the euro allows better cross-border comparability of prices, which can fuel competition, we all know that, and support cross-border trade flows. The benefits of euro adoption, however, go far beyond the benefits of simply switching from a national currency to the euro. Within the euro area, diversification of savings, financing opportunities in a large and integrated financial market is possible. Further, with relevance for the economies of Central, Eastern, and Southeastern Europe, the domestic pool of savings may become larger if household savings that are currently held abroad are repatriated. At times of heightened uncertainty or crisis, euro area members and their banks have access to financial support through the European Stability Mechanism and access to ECB financing or liquidity, which goes beyond the means which non-members have at their disposal. Further, participation in the banking union leads to improved financial stability through more harmonized supervision for large international banking groups, which is particularly relevant, of course, in Central, Eastern, and Southeastern Europe. Turning towards central banks' mandates, the adoption of the euro may entail the import of monetary policy credibility and help anchor inflation expectations in a better way. Participation in the euro area also means more peer pressure. Euro area participants engage in more economic policy coordination and face tighter fiscal rules to support their policy effectiveness. Finally, countries that participate in the euro area have a stronger role in shaping common policies. This is important for two reasons, and it's a bidirectional benefit. First, it is relevant for potential new members, as decisions made by euro area institutions can have substantial impact on their economies, even if they stay outside. Second, is relevant for the euro area, that's the bidirectional benefit, as decision-making in committees becomes enriched by more diverse views. If one applies common theorems of committee decision-making for tasks that have an ex-post evaluation criterion on their decision quality, the larger and the more diverse the committees are, the better are their decisions, as long as the cost of decision-making is not growing more quickly than the benefits of enlargement. Committees are always preferred to one-person shows in monetary policy, and that's true for many, many countries. This brings me to our host country today, Hungary. How would Hungary, should it consider to change its monetary regime, be affected by the benefits of the euro, which I've listed? Let me start with transaction costs. The euro is the most important invoicing currency for Hungary's external trade. Eliminating these costs would lead to notable savings for households and businesses and could have a beneficial impact on cross-border trade flows. Turning to foreign exchange risk, this was almost exclusively eliminated for households with foreign exchange loans in 2015. Yet, foreign exchange loans continue to play an important role for firms, while their debt liabilities towards non-residents, including foreign parent companies, create an additional exposure. Since the overwhelming portion of this foreign currency debt is very likely dominated in euro, it would automatically become local currency debt upon the introduction of the euro. Clearly, these and other benefits do not instantaneously materialize upon euro adoption, but accrue over time during the ongoing convergence process. But there is no free lunch. Having talked about the potential benefits of euro adoption, it's only fair to also point out potential drawbacks and concerns about giving up one's national currency. The loss of monetary autonomy and the ability to adequately react to idiosyncratic shocks with monetary policy tools rank high in this list, and every economist knows that. However, first, euro adoption is preceded by a closely monitored economic and institutional convergence process and harmonization of policies to mitigate cyclical and structural misalignments. In cyclical terms, the output gap and inflation of many non-euro EU members are increasingly aligned with the euro area. Second, the monetary autonomy in European EU member states outside the euro area may be more limited than it appears at first sight. Third, let me remind you that monetary policy always faces trade-offs. Trade-offs are the very bread and butter of monetary policy making. Even a hypothetical full homogeneous currency area cannot escape the mother of all monetary policy trade-offs, that is the short-run trade-off, of course, between inflation and unemployment embodied by the Phillips curve. It is a job of monetary policymakers to take decisions subject to the constraints of many trade-offs. Other reservations against euro adoption center around the asymmetric impact of external shocks. Uneven transmission can transform a policy decision that is in principle appropriate for all members into a blurred signal of varying strength across countries, regions, sectors, and economic agents. This is a very legitimate concern. Fortunately, the increased availability of granular and high-frequency data allows us to look at monetary policy transmission under an even more powerful microscope today. Further, we have tools to address these issues if necessary, that is, if there is a really substantial problem for the euro area, and these tools are the Euro Systems Transmission Protocol instrument and the outright monetary transactions. Finally, there are often fears that the changeover to the euro might cause additional inflation. According to the available estimates from recent euro introductions in Central, Eastern, and Southeastern Europe, these fears are usually somewhat exaggerated. Euro adoption seems to have led to only small and temporary additional inflation increases. Let me conclude. The euro area has started with 11 members in 1999. Now 21 countries share the euro as their common currency. Europe can and must provide a global pillar of stability based on its sound, rule-based, and stable institutions. In particular, Europe can build on the euro, further strengthen the international role of the euro, enlarge the euro area within Europe, and thereby promote also prosperity in Europe and its neighborhood. It goes without saying that the non-euro EU members, of course, decide on their own, based on their own democratic values about their preferred monetary regimes. After all, a currency is more than a technical aspect of an economy. It contributes to the national identity and it provides symbolic value. I remember how difficult it was for many Austrians to part from the shilling in 2022, and actually we still exchange shillings for euros at the Österreichische Nationalbank, although the volume every year decreases. However, there are still some people that find shillings in their attics or in some hidden places in their houses. And obviously, the initial costs of a currency regime change are non-negligible, this transformation phase, for the government, for the population, but also for firms like OnlyUp and for the consumers. I'm of course not in the position to make any recommendations today. For Austria, being a member of a larger club with full access to all safeguards that the euro affords increases resilience and strengthens our country economically. This is particularly important in the current volatile and uncertain global environment that is characterized by advantages of size and scale. Obviously, Hungary will be a welcome member of the euro family once it sustainably fulfills the convergence, the Maastricht criteria, and takes the deliberate political decision to join. Let me conclude with a positive note. Times are uncertain and prospects are less optimistic than several decades ago in the populations. Structural change is difficult to master. Companies such as OnlyUp struggle, and the perception is often that Brussels and the capitals do not pursue necessary reforms quickly and efficiently enough. At the same time, the European Union has always been a complex institution with different views, speeds, and approaches. And now the positive note is in order. The EU has embarked on large-scale projects over the last decades. For instance, the single market, the Schengen area, the euro, with Alexander Lámfalussy as one of the fathers, and above all, of course, peace within the European Union. On these projects, the EU has largely been successful. And as a consequence, additional countries want to join the European Union. I'm convinced that the completion of these projects and also the extension of the European Union, alongside the introduction of new large-scale projects, such as the Savings and Investment Union, will be beneficial to all member states and thus be feasible in the not-so-distant future. We probably have to be a bit more self-confident as Europeans, in the spirit of Alexander Lámfalussy, on what we can achieve together in the interest of all European citizens. Thank you very much.
Thank you very much, Governor Kocher, for your excellent speech. It was really good to listen to the different viewpoints, and now I can't wait to hear the discussion of all these topics Ladies and gentlemen, thank you very much for staying with us at the Lámfalussy Lectures Conference. Our first panel discussion, titled Macroeconomic Adjustments and Policies, will examine the macroeconomic implications of global geoeconomic fragmentation and rising trade tensions, focusing on global imbalances in current accounts, growth, inflation, trade flows, and debt dynamics. The discussion will explore how macroeconomic policies can foster resilience in an era of uncertainty, the role of policy responses, specifically monetary and fiscal policies, and the challenges of sustaining debt ratios and external stability amid turbulent global trade and investment landscapes. Please join me in welcoming Mr. Dániel Palotai, Deputy Governor of the Magyar Nemzeti Bank, who will moderate the discussion. Let me also introduce the participants of the panel. Ms. Catherine L. Mann, external member of the Monetary Policy Committee of the Bank of England. Mr. Athanasios Orphanides, professor of MIT Sloan School of Management, former governor of the Central Bank of Cyprus. Ms. Carmen Reinhart, professor of the International Financial System, Harvard Kennedy School. Mr. Jeromin Zettelmeyer, director of Bruegel, a Brussels-based economic think tank. Deputy Governor Palotai, the floor is yours.
Thank you very much, and a warm welcome to the first panel discussion of the 2026 Lámfalussy Conference. We have a very exciting topic in front of us. Of course, we are living through an environment which is not only characterized by a series of shocks. Actually, we can say that a new architecture of shocks is hitting the world economy, from trade tensions, from volatile capital flows, fiscal distress, debt overhang in a number of countries, geopolitical fragmentations. These all complicate the policymakers' everyday jobs. And the only difference, maybe one key difference between previous periods of crisis is that these shocks seems to be hitting the world economy in a much less forgiving environment. This is what complicates policymakers' task. And therefore, the question remains to what extent and to how long these imbalances can be sustained. Because imbalances have been part of economies, sometimes large imbalances which seem to persist for quite long. Nevertheless, at some point, imbalances may need to be adjusted, sometimes requiring harsh adjustments from policymakers. The core question is, of course, when an adjustment needs to take place. To what extent fiscal needs to take the adjustment, to what extent the real economy will adjust to that, and to how fast economic policymakers can and do react to such requirements. The United States is obviously core to this situation of the global imbalances, because the persistent US external deficits need to be financed from somehow. The US fiscal is playing a key role in there. The reserve asset of the US dollar is definitely creating a very special environment for US policymakers. I am sure the second panel will also cover these important aspects. There is a privilege, obviously, for the United States, but the question is, what is the cost of this privilege to the US and to the world? Because ultimately, these deficits need to be financed. History teaches us that the imbalances not always trigger immediate adjustment and immediate crisis, but sometimes these imbalances build up over time, and then the adjustment can be harsher than one would expect. Today, where are we today? Today, these imbalances have become much more visible. The large deficits of the US is offset partly by China's trade surplus, high savings and weak consumption in China, which is a challenge for policymakers there. The question is how the adjustment will play in the coming years. Emerging markets are also not exempt from effects of these imbalances and the adjustment processes. Sometimes emerging markets can absorb the consequences. Exchange rate pressures, capital flow volatility are part of our everyday challenges also at central banks. So the adjustment is no longer only a question for surplus and deficit economies, it's a systemic question for the global financial system. If we face weak fiscal controls in major economies, then high debt situations and debt distress can create significant crisis-like scenarios and turbulences in economies, which are not possible to be offset by domestic fiscal policies per se or industrial policy, and all these pressures are exaggerated by requirements for climate transition costs, for defense spending, and supply chain restructuring, which we are seeing. But of course, these shocks are not only regional, all these shocks propagate through the macro-financial linkages. And this brings us to the dilemma of today's panel. I would like to introduce the first set of questions to this panel. What do you think? Are we observing manageable reconfiguration of the global economy, or is the accumulation of the vulnerabilities which we are witnessing something that requires a more painful adjustment? Do we think that external imbalances, deficits are still sustainable in a world of dollar dominance, where we have deep capital markets, or are we overestimating the durability of this environment? Do we think that surplus economies can rebalance to a sufficient degree that these imbalances will moderate, or do we think that emerging markets will have to bear more of the adjustment burden? These are, of course, very difficult questions. And in the first set of interventions, I would like to ask your views on these general questions, and then we can delve into more specific policy questions. Catherine, maybe I would like to start with you.
Thank you very much for the opportunity to join in the Lámfalussy Conference. It's the second time that I've been to this conference, a lovely conference center, tremendous renovation to the central bank historical building. And this morning's interventions really quite on point to some issues relevant around the world. Now, on the topic at hand about global imbalances, you know, I feel this is déjà vu all over again. My background and experience includes working in Latin America in the late 1970s when I was working in the private sector, and all those financial loans to the Latin American countries from US banks were considered good loans at the time. A few years later, not so much. Then we could go to Asia and long-term capital management. About 10 years later, things looked fine until there was a mismatch in long-term capital management's portfolio. Didn't work out so well, and that catastrophe extended to Russia, of course, and then to countries in Asia. We could then go to the imbalances associated in 2001, which actually ended up not so bad because it was .com. .com was not such a bad percolation to the global economy because it was basically the high-stakes poker game that was happening with the .com, Pets.com, and so forth. High equity markets in the U.S., but it was owned by relatively few people, and so it really didn't percolate through the way the other ones had. Of course, now GFC. Okay, that was really the most recent, mother of all imbalances that don't work out well. So if we think about the commonality between those episodes, most of those episodes, there's a domestic component. The domestic component is something related to import substitution or export promotion, something to do with fiscal imbalances that show up in savings and investment imbalances as well. So that's one side. The other side, though, is something about financial opacity, for example, in the Latin American context, it was originate, syndicate. Nobody actually did their due diligence. The originators didn't do the due diligence because they were going to syndicate it. The syndicate, the ones who bought out of the syndicate said, oh, well, somebody else did the due diligence, didn't they? Not so much. Long run versus short run, again, long-term capital management. The regulatory internal systems of risk management, not quite done correctly. Mortgage-backed securities, that's another example of the equivalent of originate syndicate. Slightly different manifestation of it, but the same sort of thing. So there's something that happens on the domestic, real side. There's something that's happening on the financial side with regard to incomplete transparency about the nature of risks. So global imbalances have always had those elements, going back to, right after the breakdown of Bretton Woods. So 25 years ago, I wrote a paper about the sustainability of the US current account deficit, which took a lens particularly on these issues, as I say, 25 years ago. And I think those issues are relevant today when we think about the sustainability of the US current account and some other countries who also have deficits. On one side is the sustainability as measured through a domestic lens of how much interest payments on the sovereign obligation is going outside the economy. That is essentially what differed, for example, a Japanese situation with a surplus. They just recycle JGB interest rates internally to the economy. But the US and some other countries with large external deficits, 30%, 40% of the treasury securities or other sovereign securities are owned abroad. And that exit of interest payments, 3%, 4%, becomes a very big number when you're looking at a share of GDP that is no longer internal to the economy. So that's a very important question when we think about pressures on sustainability and resilience. But there is the other side, which is the financial side. And the financial side is the question of at what point is the obligation, the sovereign obligation, or the risks of a particular country too large, quote, quote, too large in the foreigner's portfolio? At what point is the asset that a country is trying to sell, whether it's a treasury security or a private sector security bond or equity, at what point is it too large in the portfolio of the foreign investor? The US has gotten away with it for a very long time, maybe not so much in the future. Other countries hit that barrier, that constraint, much earlier, and that becomes the constraint on sustainability. So that was 25 years ago, and I think we have it playing out today. The one thing that is new, the sort of the new kid on the block in terms of the terminology that is showing up increasingly in the vocabulary of the causes of current account imbalances and so forth, is industrial policy. Now, with any type of imbalance, financial imbalance and the domestic side that comes from it, the question ultimately shows up as, is there enough productivity growth in the economy to repay the obligations that the fiscal authority, or the domestic side, is generating? Where is the wherewithal to repay those obligations, which increasingly, or to a large extent, are owned by foreigners? So it ultimately is about, is there productivity growth that is going to be the source of repayments of these obligations? So industrial policy is now being viewed as, oh, that's how we're going to get productivity growth. We're going to use industrial policy in order to enhance productivity growth. And I wrote a paper a couple of years ago that looked at this, the extent to which you could argue, well, let's see, we can use fiscal policy to catalyze private sector activity. That would be productivity enhancing. We can use financial flows to help startups and to do R&D, to be innovative. Well, that's a source of productivity growth. That sounds like a good idea. There are public goods, climate, national security, and we can use fiscal or industrial policy to guide investment in those sectors. That's productivity enhancing. So I think it's useful. Those are plausible arguments. They've been out there for a long time. They just have kind of this new vocabulary of industrial policy and the policies that underpin that as well to have a lot more salience. So the question is, does that have traction? So the way to evaluate that is to use the data. There are two new sources of data on industrial policy, on whether or not it maps into these possible ways it can enhance productivity growth and the wherewithal to repay the obligations that are being generated by the fiscal authority and it being intermediated by the global financial system. So we can look at data to see whether or not that matching is true. And there are two sources of data. One is the new industrial policy outlook, NIPO, that comes out of both the IMF and the Global Trade Alerts. And there's also quantifying industrial strategies database at the OECD. So you can look at those two data sets to evaluate, are these arguments that are being put forward legitimate? And of course the answer is not so much. The mapping between what could be productivity enhancing industrial policy and the actual industrial policy that is being implemented is quite poor. And so in the end of the day, the sources of global imbalances and the manifestation and the resolution are going to look a whole lot like that list of déjà vu all over again that I gave you at the beginning.
Thank you, Catherine, for this interesting insight on industrial policy, what it can affect, what it cannot. And I also want to pick up the earlier point you made on the net external debt, which is key for a number of emerging market economies, including for Hungary, where this had been a key vulnerability for last crisis episodes, the large exposures and the financing structure of the net external debt. Which I should reflect here on, that Hungary has come a long way in reducing those imbalances. Nevertheless, there's still a long way to go before our country can, for example, become a net lender to the rest of the world, as opposed to being a net debtor to vis-a-vis the rest of the world. Let me now move on and ask Athanasios to comment on the general question on the global imbalances.
Thank you, Daniel, and it's a real pleasure to participate at this event. It's my first time here. And the overall theme is global imbalances for the conference, but I will also want to say a word about macroeconomic adjustments and policies, which is the narrower topic of the session, specifically within Europe, inspired by Alexander Lámfalussy and his ideas. Now, the economics of global imbalances, internal, external issues, are brutally simple. Surplus economies underinvest or underconsume. Deficit economies overspend, as long as surplus economies are willing to finance them. But this is the static analysis. And we need to understand the dynamics of imbalances over time to get a more complete picture, and importantly, to assess the welfare implications for different economies over time. And to that end, static deficits and surpluses are not all the same. Not all deficits are bad. Not all surpluses are good. And I think it's useful to look into this a little bit more closely. Now, as is often the case, local politics can influence policies and decisions that determine economic outcomes over time. And yes, geopolitics from time to time, as recently, is becoming a dominant factor. So ultimately, the trends are going to be determined by local politics and geopolitics. So let me say a word for three key blocks. I'm not going to say much about the US now. We'll come back to that in a minute, I'm sure. Yes, I live in a deficit country, and that means that someone is financing from outside the world part of my consumption. I consider myself the average consumer in the country. That's how it works. And yes, the US can get away with it for the time being, but we'll come back to that in a minute. Instead, I want to say a word about two surplus blocks that I think we need to be thinking especially carefully in the European context. Consider China. Surpluses in China reflect, in my view, successful industrial policies. And we've just heard from Catherine that, yes, we cannot take it for granted that industrial policies are going to be successful. But China is the example that, yes, you can actually have successful industrial policies. You have government support for investment in emerging technologies. Now, that was also coupled with household oversaving for a generation that is not feasible to enforce everywhere around the world, but was possible in China. And if we look at China's path over one generation, we see that China is now reaping the benefits of global leadership in industries of the future. And yes, this is a surplus economy where surpluses have been good. Now, let's look at Europe, because Europe is the other major surplus bloc at the moment. But I think the story is very different. For Europe overall, it is instructive to reflect on the role of fragmented local politics, which meant you can't really have the successful industrial policies. And I think Catherine's data probably talk a lot about Europe, not so much about other parts of the global economy. And we have a problem in Europe. We have mistrust among EU member state governments, especially since the global financial crisis that led, among other things, to the UK exiting the European Union, which I don't think is in the interest of anybody in Europe overall. And we have a problem in the absence of a common government that can act in the best interest of Europe. Now, what this has resulted in is severe underinvestment in emerging technologies, sustained weak demand for nearly 2 decades. The result is that while similar to China, the European economy is in surplus, unlike China, the static surpluses in Europe are a reflection of an economy that as a whole is falling behind instead of moving ahead. Now, global imbalances will not keep widening. Trends that cannot be sustained forever eventually unwind. The question we should focus on is how economies will adjust to the process over time and end up well after the transition. So this is what brings me to the macroeconomic adjustments and policies with Europe, where I would question the wisdom of the policies that have been adopted in Europe since the global financial crisis that have converted Europe to a surplus economic bloc. Let me remind you, before the global financial crisis, Europe overall was in balance. Some member states were in surplus, others in deficits. Since the global financial crisis, imbalances within Europe have been handled with policies that destroyed potential growth in the name of pushing member states that were in deficit position to balance. No change effectively for those economies that were surplus, a lot of damage in those economies that were in deficit. The result is that Europe is now a surplus economy overall, but with diminished potential. My view, Europe would be doing better today if it were not a surplus economy overall. The potential has been there all along, but the promise of the European project remains unfulfilled. And part of it is the difficulty of finding an effective implementation of industrial policies that could help us move ahead. We must invest better in our future if we are to fulfill Alexandra Lámfalussy's vision for what Europe could be.
Thank you, Athanasios. You made very good points enlightening why not all deficits are necessarily a bad thing and not all surpluses are good. And we will come back also to the question of the US in this very important question. Carmen, over to you, please.
Thank you. It's a real pleasure and honor to be here, and with a panel that I've known well for many, many years. So not all current account deficits are bad, but most of them have ended pretty badly. So that is why we have a session on global imbalances, because we're afraid that when the imbalances get corrected, the correction is often through a crisis. So I'm going to start out with some basic identities. I am going to tilt my remarks to the US because they are a major source of the global imbalances, being the world's largest capital importers. It's important to remember that the current account deficit is saving minus investment, and that saving has a public sector component and a private component. And, you know, I am going to say a little about the large imbalances and then why they've gotten worse, with an emphasis on the second part of why they've gotten worse. Catherine made the point already that the imbalances have been with us, and you also made the point, they've been with us for a long time. When I was in Wall Street, this was my first job, China wasn't in the radar screen, so the bashing was with Japan, and then Korea, and Germany, you know, and it was voluntary auto imports, quote, you know, it was very much a concern about the same imbalances, except the surplus profile countries was somewhat different focus, you know, before we pivoted to China. So this brings me to the old joke about what the IMF stands for. It's mostly fiscal. And in the US, the longevity of the imbalances is importantly about it's mostly fiscal, the US deficit. And that applies to the long-standing nature of the imbalances, but also to the worsening in recent years. So I think, you know, if we're going to talk about the worsening in recent years, again, with a focus on the US side, one starts out with a big deterioration in fiscal balances and the surge, the associated surge in US government debt. To your question, how policy will correct these, your guess is as good as mine. There is no sign in either party in the United States that the issue of fiscal correction, of getting the fiscal house in order is a policy issue that quite the contrary. We've seen the recent administration take on tax cuts. And by the way, if the US debt to GDP looks bad vis-a-vis, with the exception of Japan, any other advanced economies, it looks far worse if you look at debt to revenue, because revenue levels in the US are especially low, especially in comparison to Europe. But it would be oversimplifying to say that the whole story is of the worsening in recent years in fiscal imbalances is fiscal, although it is mostly fiscal. We haven't mentioned, and I'm not doing this because it's fashionable to bring up AI, which it is, right? You go to any conference and AI is brought up, whether it's relevant or not. It's actually quite relevant in this context. The other part, I mentioned that current account deficit is saving minus investment. Well, if you look at the flow of funds account that the Federal Reserve publishes, they publish data quarterly from 1945 to the present. What you will see is, you know, there's all this talk about the dollar's questioned, its reserve status perhaps under threat, the reduction in global appetite for U.S. treasuries, and that is reflected indeed reflected in the flow of funds account. There is, since 2014, a decline in rest of the world's holdings of U.S. treasuries. However, rest of the world holdings in U.S. equity has soared. And why am I bringing this up? The current account equals the capital account. The capital account, a lot of the rest of the world surge in the demand for equity is very much connected to the AI phenomenon. And it's been financing a surge in investment that's also very idiosyncratic to those industries. So this has been the orders of magnitude. Let me reiterate. If you look at the data, the latest being fourth quarter of 2025, it's at an all-time peak, and by a huge margin, and in nominal terms, what we've seen in the last 5 years has doubled the amount of rest of the world's holding of US equities. And with it, if you move to the next step of aggregation, total financial assets held of the US, held by the rest of the world, that are at an all-time peak. Clearly part of the imbalance story is a policy phenomenon, the fiscal side that I noted too early, but part of it is also this phenomenon that has rebalanced the global demand for assets. It's shaped it in a very, very important way in recent years. Now, how does this get corrected? I noted that on the policy side, the fiscal, the political, the signs that there's a political consensus of any sort in either party to address what I agree is an unsustainable deficit debt trajectory in the U.S. Isn't there. How does an overinvestment phenomenon get corrected? Usually not prettily, right? If the AI phenomenon generates a lot of overinvestment, which is likely the case, right? This is not, we're not all winners. It's a winners take all. There will be few winners. There will be overinvestment. Then I think one has to be rightfully concerned at this stage, which the choice of topics, and I congratulate the organizers, address. This is something we should be thinking about. How does an overinvestment bubble or an overinvestment financed increasingly, I would note, increasingly financed by debt, get corrected? It's a source of concern for financial stability. Let me stop there.
Thank you, Carmen. You have been extremely clear in explaining these imbalances in basic balance sheets and basic equations, which one should not forget if one doesn't want to lose the big picture and understand what is doable and what is not doable. You have also not been too optimistic on what policy we can expect from policymakers. Let's come back to that at a later round and also try to think about possible coordination and what coordination can achieve. But let me now give the floor to Jeromin on the general question first. Thank you.
Thank you so much, Daniel, and also thank you so much for inviting me. Thank you to the MNB and particularly to Governor Varga. So I was last year with Zsolt Darvas, I think it was in September of 24 when Hungary had the presidency, and in your previous capacity you were a very gracious host, and now you're doing it again, so thank you so much. Okay, so on the questions at hand, let me make 3 points, one about the facts, one about the interpretation of the facts, and the other one why there is indeed reason for concern, where I'm going to echo some of the things that Carmen just said. So on the facts, global imbalances are very far from an all-time high, but what has happened is a pretty fast growth since 2019. Not dramatic, by about 30% if you look at global surpluses and deficits, but quite a significant growth. Now, this growth starts from a really low level of imbalances, from the basically lowest level of imbalances in 30 years. So then, why are we still concerned? And the reason is that there are phenomena behind this growth that are concerning to a greater extent than simply their impact on current accounts, right? They represent deeper problems. So why are these, what are these phenomena? Well, they are sort of reflective of the drivers of the current account imbalances. And so on the US side, Carmen just summarized them. It's a combination of the AI boom and a combination of US fiscal expansion. On the AI boom, I think Carmen made a very important point, which is that even if we believe that this will have the permanent productivity effects that we are hoping it will have, there will at some point be a shakeout, right? Not every firm can make it, and so to the extent that there is a lot of leverage in the system, that could be a problem, even if higher productivity growth is in fact reached. As far as the fiscal is concerned, there's a clear concern about fiscal sustainability in the US. The Congressional Budget Office projections underline this concern. There's simply no adjustment on the horizon as far as the eye can see. So this is one cause on the US side. And then on the Chinese side, it's kind of important to distinguish between permanent structural drivers, as it is in the US, by the way, and the causes for the recent increase. The recent increase is what makes us so worried, and so here the driver is some combination of a demand deficiency in China that was caused by the collapse of the real estate bubble and a strategy of the government to really push in a sense, absorb some of the resources that were freed through the collapse of the real estate bubble by really doubling down on the tradable sector, right? So that combination of structural policies with a cyclical phenomenon gets you this very fast rise in the trade surplus, right? So the increase in the trade surplus is way bigger in China than the increase in the current account, right? The increase in the current account is still fairly modest. The increase in the trade surplus is roughly a doubling from about 3% of GDP to about 6% of GDP. Okay, so these are the underlying drivers. Now, why are they a source of concern? So with respect to the US, I'm just going to follow up on what Carmen sort of suggested. So it is, I think, mostly the idea that if there is a combination of a reversal on the current account with a fiscal crisis in the US, which is a low probability, but it is a possibility, then we're going to see a rather different type of crisis from what we saw in the past, right? So in the global financial crisis was a very bad crisis, but the form that it took, it was a flight of risky assets everywhere in the world, including in the US, into US Treasury bonds. The US maintained its status as a safe asset, and so it was not a run on the US. On the contrary, the dollar strengthened. So this time, there is the, not very likely, but possibility that this will be a run on the US. So what Carmen coined the term many years ago of a sudden stop, right? Usually we see sudden stops in emerging markets. Maybe we will see a sudden stop in the US. Why would that be so terrible? Two reasons. When we say global imbalances are not that high in levels, this refers to flow imbalances, the current account. What is historically high in level are stock imbalances. So the US net international investment position is almost 100% of GDP negative. It's about 25% of world GDP. So sort of imagine if this were wiped out, it was like 25% of GDP worth of world wealth would be wiped out. Now, it's not going to be wiped out, and nowhere near there. But what this does say is that a very large exchange rate correction in the US could have very large wealth effects on the rest of the world. And then the other, of course, even more terrible prospect is the idea of, the dollar, the US Treasury is sort of losing their role as the anchor of the world's financial system, the role of collateral and so forth. That would happen if there were a large widening of risk spreads and a large collapse in the value of treasuries. So that's one side of what we're concerned about. The other side, what we're concerned about, is because of what is behind the Chinese growth in the current account surplus, and this is this flood of Chinese net exports, which is threatening the industrial sectors of economies worldwide. It's particularly threatening advanced Europe, because that was advanced Europe's growth model until relatively recently. And now we have China as the new Germany. And that is of great concern, both because of the potential direct impact, but for me, just as much because of the potential reactions in Europe, which can go really bad politically, economically. We have already seen a very large demand for protection in Europe. And what this reaction seems to forget is that while the rise in the flood of exports is very much an imbalance phenomenon that could be corrected by policy actions in China, like a revaluation of the renminbi, and if there's no such policy reaction, which probably should be dealt with by some sort of response on our side, that slows that phenomenon, the more fundamental problem that is behind this, which is that China is a very large country that has caught up economically in terms of technology, in terms of sophistication of exports with Europe. That is not a global imbalance phenomenon. That is a development phenomenon. And we're not going to be able to deal with that through protection. We will have to deal with that through structural adjustment, transformation in Europe, more investment by doing our homework. And this is an angle that is being, in effect, sidelined in Brussels and I think in many capitals right now.
Thank you, Jeromin. You made a very interesting point by pointing out that imbalances are not historic highs, and I think you refer to the flow imbalances, current account imbalances, but at the same time you also mentioned that stock imbalances are huge, and these go hand in hand, and definitely long-time adjustment in the flows will be required to sort of adjust existing stock imbalances. And here you mentioned two large players, which I would like us to focus right now on the role of the US and of China. And let me now come back to Athanasios and ask you the question. So assuming that we accept that the US consumption, US fiscal rising deficit, high deficits and public debts are the key drivers of these imbalances. We could conclude from that it's hardly conceivable without an adjustment in the US that these imbalances would be corrected. How realistic you think this is going to happen? And what will be the implications for the US and also for the global economy and China?
Well, I hope you don't want me to be more optimistic than we just heard from Carmen. I can restate the question as follows. In a democracy, can we expect adjustment in a process that does not meet the political feasibility criterion? And a fiscal adjustment in the United States needs to meet the political feasibility criterion if it's to be successful without outside pressure and without a crisis. Just observing the political picture in the United States in the last few decades when I've been in the country, I noticed that from time to time we have had politicians with a long-term vision trying to promote good policies, and invariably the voters have been punishing them. I can remind you, going back, of a presidential candidate who won an election by promising not to raise taxes. Read my lips. And then he raised taxes, and of course he lost the election. I can remind you years later of two candidates, and one of them saying, we need to preserve funds so that we have social security and healthcare payments. I promised to have a lockbox to save the surpluses. Of course, he lost. So these are the lessons that the political establishment on both sides have taken away from them, and the political feasibility criterion is not being met. So I wouldn't count on this. But I would actually say that that's not the end of the story. I think Europe could help the US. I'm a European. I hope that in addition to fixing Europe and reaching our potential, we can also help others. If only in Europe we had taken advantage of the promise of the European project, of the promise of the euro, if we had created in Europe an alternative to the global currency that we now have, we would have helped US politicians see the light, and we would have made it more urgent for them to have the fiscal adjustment that would help us all. So again, I hope from the European perspective, we can help them in the United States in that regard.
Thank you, Athanasios. You brought into this discussion political economic considerations, which obviously cannot be neglected. Let me now turn to Carmen. Carmen, in a recent piece you wrote about the privileged status of the US dollar, which has led generations of US policymakers to be complacent about the imbalances and the risks of a growing current account. Can I ask you, you think that the US can reduce actually and will reduce the twin deficits without endangering the reserve status of the US dollar? And what do you think about the post-pandemic interest rate environment, whether this is conducive to the reduction of imbalances and policymakers taking the necessary actions?
Let me turn your question around. I actually think if the US did move to a policy of fiscal correction, it would increase the confidence that the US dollar may have a longer lifeline as a reserve currency. It has become increasingly a source of concern, and we've heard this from various speakers and very distinguished speakers earlier today about the concerns of the sustainability of you obviously, the term reserve currency and unsustainable debt don't go hand in hand. So I actually think that if, in the unlikely event, which I really like what Athanasios had flagged about past efforts to tackle the debt and deficit issues delivered, in that eventuality, it would increase the attractiveness of the US dollar as a reserve currency. The main issue why the dollar remains a reserve currency is the lack of alternatives, right? Turning to China, you have non-convertibility. I always, and Catherine knows what I'm about to do, quote Rudy Dornbush, Professor Rudy Dornbush from MIT, when he said, people go to a party when they know they can leave when they want to. And this is, of course, referring to the issue of capital controls and the barriers that imposes towards having a reserve currency. And then, of course, the euro, and what Athanasios has said, the people don't buy euros or don't buy dollars, they buy assets. And the underlying debt markets in Europe remain fragmented, do not provide the liquidity that is provided by the treasury market. So it is a lack of alternatives, and that brings me to why there is complacency by US policymakers that the rest of the world will always be willing to finance. I think you push that argument too long and you run up against the unsustainable debt issue, and that sets the stage for a rude awakening.
Thank you very much. Very clear points. Let me come back to Jeromin. You mentioned the possible role of Europe. And I'm wondering whether you could comment on the thought in one of the a paper you co-authored on European investments, that European investments, more investments could help reduce the excessive savings in Europe. And perhaps you could also comment on the importance and what you think about the necessity of the European Savings and Investment Union, where we stand in that, and how that could help reducing these global imbalances.
Yeah, two points. I mean, first, maybe unlike China, the global imbalances angle, the surplus angle, is not the ideal angle to motivate reform in Europe, because if you were, very serious about reducing the European current account surplus, you would start with the very, very high savings of a handful of countries. Now, those countries which have effectively structural current account surplus on account of these very high savings, are also the most successful in Europe with respect to growth. So you wouldn't tell them to completely change their economic model. So we usually go with this intersection between what's good for global imbalances and what's good for growth, and then out pops the standard recommendation, which is we should be increasing investment. And I mean, here, something that Athanasios said at the beginning, he almost wishes, we would have had a bigger deficit, right, through a more vigorous thing. So now we're turning this around. So the problem with this is that the times when we had a nearly balanced current account were those of an unsustainable investment boom in half of Europe, in the so-called peripheral countries. And so to engineer an investment boom that is not unsustainable across all of Europe is way, way harder. And so the short answer to your question is, I think that something like Savings and Investment Union is necessary for this, but not nearly sufficient, right? So you're going to need to really hammer at this from many angles. You're going to need single market reform that goes much beyond the financial sector and includes areas like energy markets, making it easier for companies to expand, which also then makes them more attractive as financing targets. But you will probably also need transformational reforms at some national levels that could go into pension reform, it could go into labor market reform. So you need to throw a lot at this problem, and at this point I'm basically pessimistic that we can pull this off. So I don't think we will be getting an investment boom in Europe. I've never lost hope on this, but we're going to have to do many things together at the same time. And right now, the moment where we had this at the forefront of the agenda, which was essentially the Draghi moment, the post-Draghi moment, has passed a little bit. The motivation is back because of the sense that we need to stick together, and we are in a relatively more worse position. We're threatened from all sides. But this is not usually the time for great collaboration, except in some areas like defense, which are important, but they're not going to save us by themselves.
Thank you, Jeromin. You were right in not being too optimistic. Nevertheless, I would like to turn to Catherine. Maybe she can give us a more positive message on coordination, which Jeromin brought up. Actually, the Bank of England recently published a paper on the importance of international cooperation to reduce the excessive global imbalances. What do you think, which are the fora, the appropriate fora or the relevant fora, and the institutions which are best suited to facilitate this, but also to be realistic and to reflect on what Jeromin said, how realistic you think this is possible in this very fragmented, geopolitically fragmented environment, and what do you think is coordination possible when, given the existing or the lack of fiscal and monetary spaces in the various economies which would need to adjust?
I have 9 minutes. Good heavens, to be optimistic. So I'm gonna go back to my focus, which is on the importance of understanding the incentives and the behaviors of the financial sector, because that is the intermediary between the savers and the deficit, the fiscal deficits, and those who are financing it. And understanding the incentives and the behaviors there, I think, is very important. And I do think that there is a coordinating body that can be helpful. But let me give you just a moment of history again. If we think about the Latin American debt crisis and how it was solved, it was a financial crisis having to do with lack of transparency in the exposures of the economies and the currencies associated with that. The banks were lending in dollars, the countries were, not dollar-based. How did it get solved? It got solved by Treasury Secretary in the United States because all of the banks were basically US. So it was financial, it was solved by the Baker Plan, ultimately the Baker Plan, and that kind of solved the problem. It took a long time, but it ultimately was a financial sector solution. LTCM, long-term capital management, how did that kind of, it ultimately percolated in a not good way, but LTCM itself was solved by Greenspan, because I was working for him at the time. Greenspan said, you guys, meaning US financial firms, get together in a room and figure it out. It's your problem, you figure it out. I'm just telling you, don't come out until you've got it done. So small number of players, mostly the US, and so forth. Fast forward to the global financial crisis. What institution gets forged in the GFC, which again was totally a non-transparent situation with multiple players in terms of financial intermediation? You had your German savings, getting a lot, the German savers putting all their money into US mortgage-backed securities thinking that they were safe, not so much. So financial intermediation playing a key role there. What was the institution that was forged at that time? Was the G20. It was forged in the financial crisis as a way of coordinating multiple governments, but also multiple representatives, or governments on behalf, shall we say, of their financial sector, private financial sectors, recognizing that that coordination was critical to resolving the crisis. There have been other issues, of course, in the G20 since then. I myself was a G20 finance deputy when I was at the OECD. The advantage of the G20, it's bigger than the G7, so that's important because the financial sector representatives are global now. They are not just US institutions. They're maybe most of the money is in the US, but they are a global set of financial institutions. You have the Financial Stability Board at the table, along with a number of other institutional representatives of the financial sector. As the representatives who sit around the table and kind of hash out how are we going to get this done, they have longevity beyond their political systems. So they're more kind of a civil service type people. Some of them are political appointees, of course, but they have a longer history of working together and comparing notes about how you can do it in one country versus doing it in another country. And then finally, the other thing that the G20 has been able to do, along with the BIS, is to try to promote transparency of exactly the kind of financial sector mechanisms, behaviors, instruments, mechanisms that are still dark corners. There are still dark corners, there are a lot of dark corners, but the G20, along with the governments that are involved, are trying to, and the BIS, are trying to promote this transparency about private credit, about private equity, so that at least you can follow the money to a much greater extent than you could before. Do we have all transparency? Absolutely not. Will there be a financial mess? Yes. But hopefully, because more transparency, it's like we've seen this before. We've seen this movie multiple times before. Let's try to have it end differently. It's kind of like when you go to the movie theater and the audience gets to participate, and so the movie always ends differently because the audience is participating in the resolution of the movie. Let's have the audience participate a whole lot more in this movie resolution so it's not quite the same it's been before.
Thanks, Katrin, for the positive note. I would almost say we should stop here, but we'll still have a couple of minutes. So I would like to ask you all one question which we haven't talked about in this discussion. What do you think about the effects and spillovers of the conflict in the Middle East and the negative supply side shock from oil prices on global imbalances? Will this aggravate the situation? Will this change everything? Or will we just muddle through it? 1 minute maximum for each. Who would like to start? Athanasios.
I can start and simply point out the obvious that policies and actions and whatever we do that reduces global wealth, reduces productivity, reduces the potential to produce, is worse for all of us. If we're already starting with imbalances, it makes the resolution worse.
Thank you. Who else would like to come in? Carmen or Katrin?
Yeah. Go ahead.
I think the short answer is I don't know what is going to happen with imbalances. But to reinforce what was just said, it clearly pivots the quadrant in which the economy finds itself into the stagnation quadrant. It increases risks of inflation, it increases risks of recession. It is very 1970-ish in many regards. So while I'm not clear at all what it does to imbalances per se, I think one has to agree that it weakens initial conditions to deal with any shocks or resolution.
Thank you. Katrin?
So I would add to that the point, it's 70-ish when we think about stagnation. The way it's different from 70-ish is back in the 70s, there was petrodollar recycling, which was a very important ingredient in altering imbalances, altering the role of the dollar, and we are not going to be in that situation this time because they're going to be using whatever petrodollars they have to rebuild their own economies. That's already been true for a while, but it'll be true in an even greater degree at this point.
Very clear. Jeromin, you have the last word.
So the war will either do very, very little to imbalances in a structural way, or in a downside scenario, it would accelerate the unwinding, mostly through some combination of a sharp market correction that pricks the AI boom, or indeed forcing a very different fiscal policy in the US. And these types of scenarios, in turn, there's a lot of heterogeneity there, right? So these could be relatively orderly adjustment scenarios, and they could also be catastrophes. But they make it more likely that unbalances will unwind.
Thank you very much. Lots of food for thought for everyone. I would like to thank all the panelists, and please give a round of applause to them, and then we give the floor for the next panel discussion. Thank you.
Deputy Governor Palotai, distinguished speakers, thank you very much. I'm sure we all found tremendous value in this panel discussion. Thank you very much for all distinguished speakers. We continue the Lámfalussy Lectures Conference with the second panel discussion. The title of the second panel discussion is The Future of the International Monetary System. This panel discussion will explore the challenges facing the international monetary system amid geopolitical fragmentation and changing trade patterns. The session considers how persistent global imbalances shape pricing conventions and cross-border payment arrangements, and how these may impact the use of reserve currencies. It assesses the status of the US dollar as the leading reserve currency and the role of the gold as a reserve asset. Our moderator will be Mr. Zoltán Kurali, Deputy Governor of the Magyar Nemzeti Bank. Please welcome him. Please give a warm welcome to our distinguished speakers. Ms. Laurence Boone, Country Head of Santander Corporate and Investment Banking. Ms. Beata Javorcik, Chief Economist at the European Bank for Reconstruction and Development. Mr. Klaas Knot, former President of the Nederlandse Bank, the central bank for the Netherlands. Mr. Robert Koopman, former Chief Economist at the World Trade Organization, Hurst Senior Professional Lecturer of American University. Deputy Governor, distinguished speakers, the stage is yours.
So thank you very much, and thank you, dear panelists, for taking this challenge. As you can see, we are up for a lot, especially at a panel discussion right before lunch. My mother used to tell me that, modesty is as important of a virtue as ambition, but let me try to set out the ambition for this panel. So in this panel, we'd like to understand the framework within which the panelists consider the topic, which is essentially future of monetary system. Then we try to figure it out what drives this discussion. Is this an evergreen discussion about the future because we fear from change, or because we are trying to sort of like foresee changes to come? Or is it purely, monetary system, is it purely a technological issue? So what roles can central banks play in this whole change, if the change is to come? How technology can shape it? And then finally, because obviously we are in Hungary, and as we heard before, Hungary once again entertains joining the Eurozone. What kind of role the Euro can play in this whole process? And what can small countries like Hungary learn from it? So I think, let me begin with the first question, and I think we will go, sort of in this order through the panel. And this is the frame within which we try to interpret the situation. So if you look at where we are, we have war, we have energy shocks, we've got shocks in fertilizer products. People talk about the risk of stagflation. Yet we see international capital markets, especially equity valuations, near all-time high, credit spreads, trading relatively low, and potentially only sort of long-end yields playing some sort of, or showing some signals of nervousness or volatility. How should we interpret this, especially with respect to, trade, regulations, government interventions in these policies? What is the framework you work with when you address this topic? Over to you.
Thanks, and first, thanks for the invitation and participating in such a high distinguished people panel. And it's indeed a very ambitious question, but very relevant, because Bloomberg was highlighting the other day that when Iran wants to put a tariff in the Strait of Hormuz, he's asking for payment in crypto or renminbi. So you know that we have some challenges to the international monetary system. I will try to set the stage, and please stop me if I'm too long. Economists, they love discussing, so you have to be very severe with us. I'm going to make 3 points. The first one is the change in the global order, and the pivot is probably the US. The second one is what it means for our economic framework, and the third one, what it means for the international monetary system. I think we cannot agree that the international monetary system was built on 3 assumptions: the US strategic commitment to multilateral order, the open capital market, and rules-based trade governance. And all 3 are under simultaneous pressure. The United States has moved towards a more transactional foreign policy. It's questioning the burden-sharing arrangement in security, in trade, and in finance. And when you look at the consequences now, if you look at trade and investment flows, at least since the mid-2020s, the geopolitical distance has become a measurable predictor of trade. And you can see that supply chains are actually gradually realigning along the political lines. I should also add that energy is now an explicit instrument of geopolitical pressure. And what we are seeing is a shift in the organizing logic of the world economy from efficiency and comparative advantage towards resilience, strategic autonomy, and supply chain control. And that means countries or regions, if we talk about the EU, they're increasingly willing to accept economic costs in exchange for reduced dependency and look at critical mineral or technology or financial infrastructure. And all of this with artificial intelligence that Carmen mentioned earlier, becoming a strategic variable. Okay, so I've listed those shifts, and I think they are structural. They are not cyclical. And they're occurring a lot faster than what the institutional framework designed to manage them can adapt. And that is one issue. And that affects trades, it affects investment, it affects inflation, and ultimately the international monetary system. And when you look at tariff and geopolitics, they interact with macro through a variety of channels: input costs, logistic costs, precautionary inventories, supply chain reorganization, and also greater dispersion of inflation, which makes it more difficult for central bank. Now, it also is obviously impacting the international monetary systems. And the reason is that the monetary system has the same structural vulnerabilities as this macroeconomic framework, in that what we had is something that is very centered and concentrated in the US. First, if we look at global FX turnover, I'm sure everyone has this striking figure in mind. It's that the dollar represents 88% of global FX turnover. It's about 50% of trade invoicing, and it's about $1.8 trillion in daily clearing worldwide, 1.8 trillion. That's for the first fact. The second fact is the infrastructure of the payment system is also very concentrated in the US, whether you're talking about trading, you're talking about clearing, and a bit less for settlement. The concentration is there. And it was fine when the US was ensuring security, but and the world was organized around efficiency. But now that we're trying to organize around resilience, it's a lot more scary, right? Like for everything, you want to diversify your sources. So you take the concentration is the first disruption to the first vulnerability of the international monetary system. The other one is the use of sanctions, and obviously that has given that may have raised anxiety in a number of countries. And if you look, for example, China-US Treasury holding, they've been divided by 2 in about 5 years. That's really fast. And the last, but not least, thing is obviously that now countries are trying to diversify their reserves, their invoicing. We're seeing a rise in Chinese currency invoicing and also in payment infrastructure, and I think we'll come back to this later. So I will stop here for the monetary system. If I go into the euro, you're going to kill me, no?
No, the euro is going to be at the end. Right before lunch. So Beata, what is your perspective on these topics?
So thank you very much for having me here. It's a great pleasure to participate in the panel. Let me give you some background to the conversation by focusing on geopolitics. Reversal of globalization, deglobalization has been going on actually for quite a while. 2016, the Brexit referendum. 2018, first round of tariffs imposed by the US on China. Then disruption during COVID and the focus on resilience, and of course, then the Liberation Day and so on. And now, as Jeromin mentioned in the previous panel, the appetite for protectionism is growing in Europe. So I would expect this trend to continue. Everybody is focusing very much on goods, but services are also affected, particularly when you think about Brexit. Point number 2 is industrial policy is going to fuel this trend. Actually, a while ago, the EBRD did a report on industrial policy, and where we came out is we said, yes, it can deliver, but it's hard to get it right. And industrial policy has, we analyzed the data, as Kathy was suggesting, industrial policy has some unpleasant features. One of them is that it has often multiple objectives. Think about Europe, we want to electrify transport, so we should have a lot of electric cars on the road. At the same time, we want to preserve the automotive industry, so we want to have higher tariffs on imports of electric vehicles from China. And these two objectives are at the collision course with each other. And the third unpleasant feature is that 90% of industrial policies in rich countries are discriminate against foreign interests, because these are tariffs, these are local content requirements, this is by American, by European clauses, and so on and so forth. So this rush, this revival of industrial policy is only going to fuel deglobalization. And incidentally, actually, industrial policy will have implications for monetary policy, for central banks, because a lot of industrial policy aims to increase investment, right? So there will be pressure on central banks to keep interest rates low. Also, industrial policy requires money, so industrial policy will contribute to the stock of debt, and again, building pressure on central banks to keep interest rates low. My third point is that deglobalization is already visible, or geopolitics is already visible in investment flows. When you look at greenfield projects, you see less US investment in China, more in India. You see countries pursuing multi-vector geopolitical strategies. Think about Saudi Arabia, UAE before the war. Think about Kazakhstan, Uzbekistan, getting investment from everywhere, from the West, from the East, from China, from non-aligned countries. Finally, we see geopolitics in the sense that governments have noticed geopolitical externality, right? Investment flows, I'm thinking here about FDI, are not only about capital and jobs, they are about flows of knowledge. And this knowledge transfer across international borders has been so successful that it actually contributed to the rise of China, not only as a trading power, but also as innovation power. When you look at the list of 2,000 companies with largest global R&D spending, a third is American, a quarter is Chinese, only a fifth is European. 20 years ago, more than a third was European, and only 5% was accounted by China. Right, so government noticed this geopolitical externality, and this is leading to restrictions on trade in goods with geopolitical rivals, so restrictions on trading goods embodying knowledge, embodying high technology. It's leading to restrictions on allowing specialists from your country to go and work in the other country. I'm thinking about US persons rule. And that's going to change global FDI flows. Let me stop here.
Klaas, can you shed light on your perspective in that regard, especially when we talk about, sort of the interconnectivity of the world, and as we discussed just right before the panel, in this kind of backdrop, the potential need or maybe the ambition to be a bit more protective for our own markets?
Well, actually, the starting point of my deliberations would be exactly the same as Beata already summarized quite well, and that is that we are living in a world of deglobalization. And I think Beata accurately described what that world sort of implies for trade flows, etc. There is only one thing I would add to her description, that whereas I always saw globalization as a sort of relatively smooth, slow-moving, continuous process, I think deglobalization is actually a much more shock-wise, abrupt process. A war here, a trade policy there, a climate disaster there, and what have you, and is therefore more, I think, more accurately described as a sort of sequence of shocks rather than a continuous process. And that actually plays a role also if you think about sort of how policymakers should deal with that. For I think economic and monetary policymakers, this is all about geo-economic fragmentation that we talk about. This is about negative supply shocks, very awkward shocks to have to deal with, because if you're a monetary policymaker, it means that you will have an immediate effect on inflation, but at the same time, you will have a negative effect on growth, which in due time might then lead to lower inflation further down the road. So you have to navigate sort of two opposing effects here. And then I guess what if you are a central banker with an inflation mandate, then it all comes down to do what is necessary, but as little as possible. And do what is necessary has everything to do with the anchoring properties of inflation expectations. So you have to be very careful in watching inflation expectations. That is something that policymakers need to do across the globe. I think that is there is no escaping of that reality. But at the same time, do as little as possible, because you don't want to create any undue harm to the real economy, which would then further down the road create exactly the opposite inflation problem. Now, if policymakers, of course, are also very much motivated by sort of what happened in the past, and there is, of course, the 2021 memory that is still very fresh in our mind. That was a global approach that all central bankers in the world took to this so-called transitory element of inflation. And, you know, the transitory element came into the debate because inflation was created because after the reopening, supply could not keep pace with demand. And obviously, you can have a debate how permanent supply-side disruptions are, or whether some of them are likely to resolve within the horizon within normally you make monetary policy. With hindsight, I think the demand was so strong coming out of the pandemic that was obviously one thing that played a role. But the important thing is, and then I come back to my narrative on the nature of deglobalization. If you look through a shock, which policymakers did in 2021, you take a sort of open risk position that if subsequently you're hit by a second shock, which of course we were in February 2022 with Russia's barbaric invasion of Ukraine, then all of a sudden that changes also perspectives on how people look at your decision to look through the first shock. So that, I think, is an important thing to take into account. On the other hand, in Europe, there is also the memory of 2011, that you can also do too much, too quick. And if I look back on the 2011 event, what happened there was that there was a sort of financial crisis brewing under the surface. There was a sovereign bank funding crisis brewing. There was capital flight brewing. The Greek crisis came to a sort of a peak only 2 weeks after this second hike had been taken place. And that was clearly something that needed to be taken into account. Now, if you then fast forward to today, where are we on the financial system? In the previous panel, it was already mentioned that there are pretty high valuations out there in stock markets, so that could be the trigger of some financial turmoil. Secondly, geo-economic fragmentation also leads to higher financial stability risks. because it means higher market credit risks, it means less opportunities for financial firms to diversify, it means a higher incidence of state-sponsored cyber attacks, and it means lesser opportunities for international cooperation to deal with the crisis once the crisis is there. So, am I predicting a next financial crisis? No, I'm not. But I'm just trying to sketch out that you always have to be on the alert also on what is happening in the financial system. I would, however, conclude on a positive note that I do think that crucial in the transmission of, let's say, micro-prudential financial risks into a systemic event are the banks. Because the banks are the core of the financial system. That's where most of the leverage is being taken. That's where the domino effects, etc., come to the fore. And I would dare to posit that the banking sector is in much, much better shape today than it was back, let's say, 15 to 20 years ago. So that is on the positive side, I think, if you want to also take this into account when having to navigate this important difference between 21, 2011. Let me stop here.
Understood. Thank you very much. So, Robert, as an expert on trade, how could we complete this picture with your views on trade policies and sort of deglobalization interpreted, in conjunction with those recent changes in the U.S.'s attitude towards free trade?
Well, Zoltán, thank you very much, and thank you to the organizers for the invitation. I very much appreciate the opportunity. So I'm going to take this more from a microstructural approach. We've seen significant changes in U.S. trade policy. I'm going to push back. I agree very much with Laurence's view on this risk versus efficiency trade-off. We saw this in the first Trump term. It was something we were very much interested in and focused on, and we did some research on this. I'm going to push back a bit on Beata and Klaus. We don't really see deglobalization. We see a reorganization of globalization along geopolitical lines. But interestingly, trade has been very resilient. Despite crazy US trade policies, right? Despite these tensions, we see trade growth being very resilient. And a big part of that is that most trade growth is driven by GDP growth, not by tariff policies. So most research shows that GDP growth explains 66 to 75% of trade growth, and trade policies maybe explain 25%. And we've had pretty resilient economic growth. So, and when we look at the trade data, we do see some reorganization along geopolitical lines, but we see deepening of global value chains in Europe. We see deepening of global value chains in North America, and we see deepening of global value chains in Asia. So the three big regional value chains are integrating more and trading a bit less across. The main result of Trump's trade policies have been to truly create trade diversion. It's fascinating to watch, but so I do a lot of this global value chain research, and what we see is direct trade between the US and China dropping significantly, particularly in those areas where there's high tariffs. Trade's been growing in those areas where there aren't high tariffs on Chinese imports. But now we see a lot more Chinese content coming from Vietnam and Mexico and other Asian countries coming into the United States. So China is essentially realigning its supply chains to the United States. The United States is going to try to stop that. But in the United States, there's a carnival game called whack-a-mole. And I think that's what trade policy is doing here. It's just going to create a more whack-a-mole situation. And I would argue that it's really macro-financial issues that can resolve these global imbalances, not trade policy. When we look at what this kind of geoeconomic fragmentation might do, we did a paper at the WTO asking what happens if there is a complete breakdown in global trade relations. By 2050, global GDP was about 7% less. For the United States, it was 3% less what it otherwise would have been. But for countries like Hungary, small, medium-sized countries, Korea, it was really horrible. It was about 15 to 20% less. So the distribution of these geoeconomic fragmentation implications are going to be quite different. But overall, they're not that big. Now, what are some of the broader forces I see here? So by 2050, we still have significant economic growth. It's a bit less because of geoeconomic fragmentation. It's less efficiency in trade. There's less technological spillovers as a result, and that is a big contributor to this rather than those efficiency losses. But we also have these scale losses, network effect losses, but at the same time, we have these forces pushing for economic growth. We have productivity. Everybody expects AI to have these big positive impacts that's going to push growth forward. So there's this tension between the trade policies and these other economic developments, innovation, investment, these very significant capital flows that I think can mitigate the effects. But we are going to experience slower growth as a result of this. That doesn't mean it's a financial crisis, although they may be in there, but it's a sea anchor when we deglobalize, which I haven't seen yet, okay, but it's a globalization and a reorganization of globalization. And if we get trade fragmentation, and then the IMF did a very interesting paper on reductions in capital flows that pretty much give you the same results in terms of percentage changes as we saw on the trade side, those two things could add up and could result in a very, reduced growth over the next few years, where we've lost, the opportunity cost is much higher than policymakers may realize. But it doesn't necessarily mean immiserization. I'll stop there.
Clear. So I guess, sort of nearing or zooming in on our topic, which is future monetary system. Obviously, monetary system needs to serve a purpose, which is, to facilitate, trade and facilitate policy. So often when people talk about the future, that is driven by some sort of a fear. If you actually consider, some of what we have heard before and kind of the market developments, especially the rise of the price of gold, it appears as if the market participants are somewhat concerned about, the future of the current system as we know it. Is it that, in your view? Is it that concern? Are they actually genuinely concerned about sort of the fiat world, or that's just a narrative? And what we are really witnessing is, alongside these processes, what we touched upon, sort of like a rearranged sort of economy or global economy, and as a result, requiring to some extent a more diversified, sort of monetary system. But is that the solution, and is that the direction of travel? So Laurence, over to you.
Thank you. You persist in ambition, I see. And I also think that actually the two positions go along the same line. We're not seeing deglobalization, but fragmentation, I think, is what we want to get away from this with trade and investment. But I think it's, as you were saying, that the monetary and financial system will reflect this. And why we are seeing the price of gold increase is because when you fear about fragmentation, when you fear that the safe reserve currency might not be providing the security and safety net that it was before, then you're looking for an alternative one. And the alternative is gold. And I think we had this morning, and the first speech is exactly what you were explaining. So what I'm getting at is there are vulnerabilities in the financial and monetary system which are reflecting the real world vulnerabilities, and I will give them into 6 most important ones. The first one is we have very expensive cross-border payment still. It takes between T+1 and T+3 to settle a cross-border payment, and the average cost is about 6.5% of this payment. That's a lot of money. The second is what I alluded to earlier. It's the concentration of safe asset. in what we can call a non-neutral currency. So Keynes failed with its banker currency. We have the SDR, but it's not a currency. The third one is also the concentration of payment infrastructure and one de facto jurisdiction. And I'm obviously referring to CHIPS and SWIFT. CHIPS, it's the 1.8 trillion transaction per day I was mentioning. SWIFT, it's more than 11,000 institutions connected under the same jurisdiction. The fourth is the gap in the global financial safety net. So we have obviously the IMF, the ESM, but when you look at the network of repo and swap line, you can see that they also reflect the geopolitical lines. So if I look at the US, for example, swaps is very focused on a restricted number with allies. If I look at Europe, it's rather defensive and mostly to protect itself, and it's also a restricted set. And if I look at China, it's very offensive in the sense that they use swap line for geopolitical and foreign affairs purposes. And then the fifth is obviously the geopolitical fragmentation and the sanction risks. I think it's very much in the mind of our partner now, which is why they're diversifying their reserves. And the last, but perhaps not least, when you're in a central bank, is to how much it depends on monetary and fiscal credibility. And Beata talked a lot about the fiscal side. So we have these 6 vulnerabilities, and it doesn't mean that anything will replace fiat currency, but what it means for policymakers, I think, is that they have to focus on this. They have to provide better cross-border settlement. They have to provide better interoperability of the infrastructure, and I'm thinking about the euro. We perhaps need to complete the global financial safety network, and we have to raise the question of the euro as safe asset, obviously, and I think everywhere, that's not a European remark, really anchor the public monetary credibility. Now, I'm not sure you will have time to get to the third question, but I think for the solution to this, within Europe, cross-border settlement is pretty good. We have it. In terms of infrastructure, for clearing and settlement, we have some elements on it, but we are missing many, and they are projects, Ponte, Appia, and many others, whose main objective, I think, should really be to focus on ensuring the interoperability across border and between the private and public sector. Because the ECB will launch its digital euro, but in 2029, some private sector solution exists today. When I look at the financial safety net, since we're in a central bank, I think when you talk about repo and swap line, it cannot be the responsibility of the central bank alone. This is something that goes hand in hand with the Council, and we might want to think about how to organize that. And then for the rest, we know. So I will stop here. I think we just need to complete, or just might be a bit exaggerating, we need ambition to complete the system and address the new vulnerabilities arising from this fragmented geopolitics.
Thank you very much. I mean, obviously, watching the clock, I might actually combine the third topic as well and drop it in, but obviously without, sort of any requirement to address that. And obviously, the third topic is clearly, technology and how technology plays a role and how central bank play a role in this whole process. I guess, reflecting on 2 points that you made, and maybe the other panelists can reflect upon this. One is that, yes, fiat debasement is not a prompt sort of issue. Nevertheless, what we can see now is that long end yields, so the end of the long end of the yield curve looks pretty much unanchored in creeping up. But if you think about it, cost to GDP terms. So, people look at the chart, they look back, they say, oh, okay, whatever, it's like 2005, 2010, we've seen this, not so recent not in the recent past, but actually if you look at how much higher government debts are, so the actual relative to GDP cost of 30-year debt in the US, in Europe, in Japan is just, sort of punitively higher. But anyway, over to Beata, and of course, very interested in your perspective.
So the environment in which central banks are operating is changing, right? We've seen a lot of shocks to trade. So now trade policy is a source of uncertainty, and that, of course, makes the work of central bank harder. Whether we talk about fragmentation, deglobalization, whatever we call it, imports used to be a friend of central banker because they were putting downward pressure on inflation. Now, with all these shocks, imports are likely to be a source of inflationary pressures. And in Europe, if we go towards more towards protectionism, that we are going to feel that as well. But let me bring in an issue that nobody has mentioned yet, which is aging. 3/4 of people globally live in shrinking societies. And this region, Central Europe, got old before it got rich. In the Eastern European EU member states, the median person is over 40, just as it is the case in advanced economies. But we reached that age at 1/3 of GDP per capita of advanced economies, right? Now, aging matters because it may change the transmission of monetary policy or effectiveness of monetary policy. Well, for obvious reasons, young people borrow to finance businesses, homes, old people borrow less. But it's going to affect also monetary policy through a different channel. Big pension liabilities. Most countries have pay-as-you-go pension system, and that's going to put increased pressure on governments, and that's going to increase pressure on central banks to keep interest rates low. It's actually very interesting when you think about how people think about pensions versus other types of government spending. If you ask people, should government spend more on unemployment? There's a whole range of views. Everybody in Georgia thinks it's a good idea. Very few people in Denmark or New Zealand share this view. But if you ask people, should government spend more on pensions? More than 50% of people say yes, in all but 4 countries for which data are available. Right? So the support for spending more on pensions is universal. Moreover, the political discourse will change as societies age. If you ask people in this part of the world, what should governments spend money on? Those over 60 say healthcare, pensions. Younger people say healthcare, education. So the support for spending more on pensions will go up. Moreover, I think the public may support governments putting pressure on central banks because we have seen over the last several decades an increase in public support for government intervention. So if you look at the data from the late 1990s versus pre-COVID, there was a big increase within cohorts, and then after COVID, another increase. And what's interesting, this is true in advanced countries and in this region, in transition economies, but in transition economies, there is an age profile. Older people are much more supportive of government intervention, while younger people are more skeptical. So as the electorate ages, the political discourse will change.
Very clear. So of course, aging is probably disinflationary, if you think about this. But I guess, what comes out of, Laurence and Beata's remarks is that we are not only talking about some sort of how do we settle, trade, but also how then policy reaction function changes as a result of what we are seeing, especially in an environment where, central banks, governments, with mutual respect for independence, need to work, together, while governments face relatively high costs. So Klaas, over to you. I'm also interested in a bit of a left field question, which is like, the pension topic got me intrigued. Obviously, Netherlands changed, pension funds. Yeah. And that probably unanchored a little bit the demand for long-end treasury, not obviously bonds and treasury bonds in the Eurozone. So how do you see this, as well as obviously the main topic, which is monetary system in light of all what we've discussed?
If you allow me, I'll get to the pension question toward the end. But let me begin on sort of the gold issue, right? I mean, why? What is gold? Gold is the ultimate hedge, I think, in the financial system. If the foundations sort of investment policy, the belief in diversification, in correlations, if some of that sort of breaks down, then gold is the ultimate hedge. Now, the foundations of the international monetary system, of course, are heavily influenced by what happens in, let's say, the core currency, the core country of the financial system, and that is the US dollar and the US. Let's not forget that about a year ago, when gold started to take off and these issues about disbasement, etc., came to the fore, that was a period in which we were still very much intrigued by the Mar-a-Lago report. It isn't much talked about anymore today, and hopefully better so, but it was a bunch of crackpot ideas from an official that was seen to be influential to default on foreign ownership of US debt, to actively undermine the independence of the Federal Reserve, etc. Now, I think some of these ideas luckily have subsided, and I would add also the price of gold has subsided a little bit. But there is still, I think, the lingering issue of central bank independence, and maybe not so much the sort of frontal attacks to central bank independence. I think that has also subsided, including within the United States, where I think a fairly mainstream central banker has now been named as the new chair, and which I think is very competent and falls within, let's say, the normal parameters that you would expect. But there is, of course, the most subtle form of undermining central bank independence, and that is fiscal dominance. And I think if you talk about this run-up that you also alluded to of longer-term bond yields, there might be a bit of uncertainty on how central banks will actually be able to preserve their independence against the backdrop of the fiscal challenges that are enormous. I mean, they featured briefly in the previous panels. We have the aging issue, the lack of fully funded pension systems in most of our societies that come on top of it. Now, the Netherlands is a positive example here in the sense that we have a fully funded pension system. By the way, thereby also something of a capital markets union, that people are 50, 60% invested in equities without themselves being aware, but that's okay. Because had you asked their own investment preferences, I don't think that they would go so deep into equities. But that pension system has recently undergone a transition, you were referring to that, from a basically defined benefit to what I would call a collective defined contribution scheme. And that, of course, means that at the long end of these pension liabilities, which are very, very long-term, 20, 30, 40, 50 years, there is less need to hedge your interest rate risk. And that has led to changes in hedging behavior, less need for long-term interest rate derivatives, etc. And that has been somewhat visible in the long end of the curve, although many, many people that I talked to in the London city have been quite disappointed because they had actually expected a much bigger effect. And the reason actually is that if you really go into the more details of the reform, the old defined benefit system was much less defined benefit than meets the eye. And the new collective defined contribution system is perhaps a little bit less defined contribution than meets the eye. So still, there are all sorts of mechanisms that, particularly for people that are relatively close to their retirement, they want security. They want the risks to still be hedged. They don't want to sort of become victim of a financial crisis that just happens 1 year before they retire. So even in the new system, there are a lot of defined benefit element still for the elderly. And that's why the need for interest rate hedging continues to be quite strong, simply because we have so many of these long-term liabilities, and people that age and go for retirement, and people that are close to retirement want security, want safety, and for the right reasons.
Perfect, thank you very much. Robert, over to you.
Well, thanks. So I guess my take would be that I think what we're seeing repriced is not so much the dollar's liquidity, but perhaps its neutrality, right? So it's been increasingly weaponized over the years. And I think it's ironic that now we see a lot of weaponization in trade, but a lot of that, those lessons learned in trade probably came about through the U.S. use of its financial leverage with the dollar. This isn't my core area here, but I do think there's some interesting elements. This leveraging of the dollar or repricing of the dollar because maybe it's becoming less politically neutral sort of reminds me of the costs that come about from the uncertainty around tariffs, right? So I would argue that most of the real costs for businesses out there around the Trumpian trade policies is the uncertainty, which has big effects on investment. We don't really see that coming through very strongly in the US market right now because of the boom in AI investment, but we do see it in the traditional manufacturing sector, which is kind of ironic, where the Trumpian policies goals, the tariff policy goals, are to build out the manufacturing sector, and we don't see that happening in the data at all. And I think this uncertainty effect on the value of the dollar is going to be pretty significant. Then I think there's this technological element that we have to be aware of. If you look at trade in physical goods has been growing pretty solidly despite all the disruptions, but trade in services, and particularly digital services, has been growing extraordinarily fast. And that brings us into a world where we have very fragmented rules and regulations compared to the goods trade, right? We have SPS and TBT regulations that help reduce some of the uncertainty around trade in goods and agricultural products. But when it comes to digital services, there's really no core agreement on how do we allow data and digital products to flow across borders. And we're also now talking about digital currencies, right? So will those two areas create even more uncertainty going forward for the global financial system? I suspect that it will.
I guess that leads us into the next one, which is a subset of the technological question, which is exactly the role of central bank digital currencies as well as stable coins. I mean, is it smoke in the mirror, or this is actually real? Given that if you think about it, sort of the largest settlement currency and the largest reserve currency of the world is the dollar, which is a liability. Obviously, the safe asset is debt. But at the same time, the Federal Reserve openly downplays the potential for CBDC, whereas US regulation privatizes, digital currencies through the Genius Act and the stablecoin regulation. Understandably, this for them the use case is clear, given the fragmentation of the settlement system and the length at which it takes to settle payments in dollars. But in Europe, the response was very different. This is a CBDC, at least the plan, without any monetary policy significance, given that it's not interest-bearing as it looks, from what we understand. Yet it tries to address some sort of a cash replacement agenda in a situation where obviously through SEPA you can settle payments very quickly in Europe. And then of course there is the Chinese, sort of example, which is a completely different one. And then there is the private sector, obviously, crypto with Bitcoin, and as you mentioned, Laurence, Iran requests payments for their tariffs in Bitcoin. So how does this look like? So how important this topic is? Is this the topic, or we are sort of like diverting our attention from the elephant in the room? Maybe a bit more briefly than before, given that I want to talk about the euro at the end. Laurence.
Okay. Very quickly, yes, it's a topic. It's a topic because of stable coins, because of the changes it implies in the Eurozone. And by the way, it is addressing some market failure, and I'll come back to this in the Eurozone. And it's also a topic because you have some regions and countries of the global south that are building their own digital infrastructure for payment, which will obviously escape the jurisdiction of the US or sanctions, or they will create a parallel, and that's important in terms of what role it will play in the global monetary system. So that's the first point. The second point is what the US is doing is, we're seeing the infancy of it with the stable coins, but it's rapidly rising, right? It's now I think about 300 billion, and some of the stablecoin providers are making significant profit. Now, it's a privatization of digital money. Basically, the way it works, I think everybody is aware of it, right? You buy a stable coin, and what the company providing the stable coin does is it invests into a safe asset, and it collects the interest payment of this safe asset. So there's a privatization of seigniorage, which is important for a central bank perspective. And it will also, because the word safe asset today is the dollar, it will also be very important, or it has the potential to be very important in terms of volume. And I think it also answers a market failure. We talked about cross-border settlement. If you look at, for example, the all-American continent, but it will go beyond, it is addressing the fact that today, if you take traditional means, it is long and costly to do some cross-border payment. Now, the third is Europe. Europe, actually, in terms of cross-border payment, we have different issues and less issues, I want to say, because we have a common currency for the single market, which is quite helpful, as the first panel mentioned it. What we have, which I think is typical of us, right, is a multiplicity of tools and instruments. So we have, for example, two type of private sector system for digital payment. So we have this solution already. We have target, but we haven't completed the whole financial architecture. So when I look at it from a European point of view, I see the CBDC as anchoring trust in public money. You know, it's Shin and the BIS who talk about the singleness of money. So with CBDC, you get that. And that's an anchor, which is very important, I think, for monetary policy. And then you have some private sector solution to make the transfer and the payments. And for this, you need a connection with the ECB block. And if we manage to do this, we have created a relatively safe anchoring in a public sector trust system where digital has brought some innovation, but has not disrupted our way, or not put into question with anxiety our way of functioning. Then, of course, and that's my last word, we need to make it work with the external world and raise the influence of the euro, but hopefully someone else will talk about this.
The dominance of the US dollar has made sanctions very effective, but has also created incentive for countries to think about alternatives, particularly among countries not aligned with the US. It has revived, for instance, discussions about BRICS currency. Now, we are nowhere near to having a BRICS currency in the near future, but if you look at the SWIFT data, you see that since 2022, since the time sanctions were imposed on Russia, there was an increase in the share of renminbi in trade transactions. Right? It's still very small in absolute terms, but the trend is there. And this trend is particularly visible around the trade with Russia. So for instance, in 2016, 90% of Chinese exports to Russia were priced and settled in renminbi. One more time. In 2016, 90% of Chinese exports to Russia were denominated in the US dollar. By the end of 2023, more than 80% were in renminbi. Moreover, you see that third countries started using renminbi in their trade with Russia, and that's particularly true in countries that have swap lines with the People's Bank of China. That's something you referred to earlier. So while the dominance of the US dollar can make sanctions more effective, in the long run, sanctions may undermine the standing of the US dollar as a currency of invoicing. That's different from being a currency of reserve.
Yeah, I wanted to add on a little bit to what Laurence was already saying on the digitalization of finance. And I think it helps to first take a bit of a historical perspective here. Traditionally, I would say that money and payment systems that have been stable have always combined public trust with private innovation in convenience and efficiency. So what I think we are currently undergoing is a digital update of the world, the combination of these two elements that we had in the analog world, cash being replaced by the central bank digital currency, and private forms of analog money being replaced in part by stablecoins. I say in part because I believe that stablecoins have proven their value added in terms of settling crypto asset transactions. It's a settlement currency for crypto asset transactions to stay within the digital space. And to some extent also in overcoming this market failure for cross-border payments, where in some of the payment corridors in the world, the traditional payments are hugely expensive, slow, not inclusive, not transparent, everything that sort of you would want to see. But I'm a bit more doubtful as to where stablecoins will go from there. Because I do believe that in the private sphere, in the sphere of private money, there is actually a superior alternative, and that is tokenized deposits. If you compare tokenized deposits to stablecoins, tokenized deposits are fully fungible. Stablecoins are not. Tokenized deposits are covered by the deposit guarantee scheme. Stablecoins are not. Tokenized deposits are remunerated. Stablecoins are not. So from the consumer perspective, yes, we also will see digitalization of private forms of money, but I do think that tokenized deposits are actually more superior. Also, stablecoins in their investment policy are heavily focused on highly indebted public authorities. It's all about treasury bills, treasury bonds, and what have you. Whereas tokenized deposits are actually covered by the entire balance sheet of a bank, which also includes credit to the private sector, financing private investment. So if stablecoins were really to take over these private forms of money, there would be a subtle way of crowding out of actually credit and investment to the private sector. And that would also, I think, be suboptimal. So the jury, as far as I'm concerned, is still out on stablecoins, also because of the well-known risks that are there. If you create runnable liabilities, unfortunately, you know that history teaches you they will be run at some point in time. Where do you run to if there is not a central bank digital currency? Question also out there. And the fact that stablecoins have a huge potential to destabilize those banking sectors where they will push further dollarization into a digital format. Some countries know dollarization in, let's say, the analog format, but through stablecoins, you can do that digitally. It goes much faster, less transaction cost. It also has some risks, I think, some spillover risks, particularly to emerging market and developing economies.
Thank you, Klaas. Robert, will it help trade? You know, this kind of a financial infrastructure that was described.
I do think it would help trade, obviously. It would help reduce trade costs. I mean, a big driver of the growth in trade has been falling trade costs, of which, again, a small percentage has been tariffs. But I do think for it to be effective in increasing trade, driving trade, there has to be trust, right? And so Klaus was talking about risks here, and I think we don't really have a very good system right now for regulating this kind of digital transformation. It's a challenge around digital services flows, and I suspect it would be a challenge around digital financial flows. So I guess there has to be some sort of approach to regulation for trust here. And if that happens, I suspect it will help reduce trade costs even more.
Thank you very much. So 2 minutes for the last question, which is, obviously Hungary is about to embark on the mission of, again, to introduce the euro. There was a project before which unfortunately failed on fiscal policy back in the 2000s. So if we embark on this mission to complete, are we joining the club of the winners, or we are exposed to risks? And obviously there was a diversity of thought and opinion during this conference. What is your views, very, very briefly?
So as I think we said before, scale does matter, and I think it matters even more in a fragmented world. So the more solid economies like Hungary on this journey will join the euro, and the stronger we will be together.
The costs of growing debt mountain, right, the cost of servicing debt will put pressure on central banks. If there is a change to independence of the Federal Reserve, this argument will be used in other countries to undermine the pressure of the central banks. So if you believe that the ECB is able to resist such pressure better than national banks, then the attractiveness of the euro should increase.
I couldn't agree more with everything that's been said. I would say, however, that you probably want to join a club that also wants to be successful itself. And to be successful itself, I can only echo what Athanasios said at the previous panel. There's a lot of work still that I think the EU and the euro area has cut out in front of it. I mean, the single market that only exists there in name, the banking union, which is a nice word, but there is less cross-border banking activity today than there was 15 years ago, not more, less. The lack of a deep integrated capital markets that would allow the many, many startups that we do have in Europe to actually become scale-ups without moving to the US to tap the capital market, but rather to tap the capital market here in Europe. These are the things that we have to move on. Otherwise, indeed, the debt burdens that are ahead of us and the aging of society, we cannot maintain the social welfare arrangements that I think we all highly value in Europe.
I do think that there's great opportunity in Europe to enhance its performance. An integrated capital market, I think, would be very, very important. So I guess the big question for Hungary is, do you want to have the flexibility that Governor Glapiński was talking about, or do you want to try to benefit from the network effects and the scale effects and the greater certainty from being a part of this club that has a good opportunity to actually improve performance? It may take a crisis to do that. If it's a crisis, would you rather be a member of the club, or would you rather have that independent flexibility to operate on your own?
Awesome. Thank you very much. Right on time. So thank you very much, dear panel. I really hope that we got closer to understanding the future of monetary systems. Certainly we got closer to lunch. So with that, thank you and enjoy the rest of your day.
Thank you very much, Mr. Kurali. Thank you very much for distinguished speakers, for this engaging and dynamic discussion. We heard several interesting ideas from our speakers, indeed. So thank you very much again. As our conference is ending, I would like to thank to all speakers and participants for sharing their valuable insights, and our audience for staying with us throughout the program. Before we say goodbye, I would like to invite Deputy Governor Dániel Palotai to deliver his closing remarks.
Thank you very much. I do not only stand in front of you, I'm the one who stands between you and lunch, so I will be very brief and not use my 10 minutes, maybe just 2 of it. So I would like to conclude by expressing our sincere gratitude to all the speakers for the valuable contributions, all raised extremely relevant insights and remarks that are shaping today's international economic policy discussions. We are after a few very, very fruitful discussions, and to me it became clear that the speakers approached similar topics and questions and dilemmas from different perspectives, but the core messages and the primary takeaways, to me at least, were very, very similar and aligned. Governor Varga started in the morning, and he underlined that central banks should concentrate on focusing on a core mandate. And this is exactly what the Central Bank of Hungary is doing under the management of the new leadership. He emphasized that the primary mandate is achieving and maintaining price stability. And he was followed by our keynote speaker, Governor Glapiński, and I saw a broad agreement between the two governors on the role of central banks. Governor Glapiński emphasized that central bank independence is a prerequisite rather than a privilege to central banks to fulfill our mandates. And Governor Varga added that mutual respect for the institutional competencies is what should be maintained. The question on the euro adoption, I at least heard a bit of differing views, diverging views. On the one hand, the Governor Glapiński explained that the benefits of keeping the own currency are very important, and he argued in favor of autonomous monetary policy. On the other hand, Governor Kocher dwelled into the advantages of adopting the single currency. Meanwhile, Governor Varga took a pragmatic approach and added that euro adoption is appropriate for Hungary once the country can maximize the benefits stemming from part of the euro area. Governor Varga also highlighted that it's in the interest of the Hungarian economy to meeting the conditions necessary for the euro adoption. This remark resonates perfectly with Governor Kocher's thoughts on that the compliance with the EU Stability and Growth Pact is in the best interest of all member states. While these are clearly two different sets of financial criteria, both represent a set of coherent financial framework which should guide our policy making. These questions are crucial for small open economies where euro adoption comes to the spotlight, and perhaps this could become a key element of economic discussions in the next years ahead. Maybe this is already a hint to future Lámfalussy Conference topics. The two panel discussions delivered an exceptional range of insight and perspectives from our highly esteemed panelists. Discussions offered valuable insight and guidance, and also forward-looking principles that could serve as benchmarks for future decision makers and economists and experts as well. In the first panel discussion, we focused on an extraordinarily timely topic, macroeconomic implications of geo-economic fragmentation and escalating trade tensions. Here, the participants explored the increasingly persistent challenge of global imbalances, and they offered valuable messages for policy coordinating for Europe, in the US, but also China. In the second panel discussion, I think that's very nicely complemented the first panel and added further effects of geoeconomic fragmentation and on the reconfiguration of the international monetary system. I just wanted to pick up a point which was very important to me by Governor Klaas Knot on the possible advantages of tokenized deposits over stable coins. Finally, I would like to thank here George Sapari, who cannot be here with us today because of he's on a speedy recovery after a small accident. And as you know, he was a former student of the father of the euro. And I think we can say here that he is the father of the Lámfalussy Conference series. He was the one of those who came up with the idea over a decade ago, and I think we can thank him for convening many of you here who are here today and who have been with us over the past years in creating connections and also bringing excellent minds together. It is a privilege for me to be part of this, and I want to thank Governor Varga for entrusting me with this task of organizing the Lámfalussy Conference. And of course, we couldn't be here without the hard work of my team under the leadership of Gina and of Lajos Fodor's team, who helped organize everything over months and months of hard work. Not visible, but definitely without you, we could not be here. And of course, you are the ones to thank for with our lunch. And I just want to thank everybody for coming and hope to see you next year at the Lámfalussy Lectures Conference 2027.
Thank you very much, Deputy Governor Palotai, for your remarks. This was indeed an excellent conclusion for this event. Ladies and gentlemen, with the closing remarks, our conference has come to an end. I would like to thank you for your attention and invite you to join for a hearty buffet lunch in the reception hall. And as we know, these events are just as much about coffee breaks and lunch breaks as of discussions and lectures. So take advantage of these as well, make connections, and enjoy your day. Have a lovely day. Goodbye. Thank you very much.